Welcome back, everyone. We've seen the markets in rally mode over the last few weeks as the latest economic data shows signs inflation might be cooling, but our first guest this morning says we're not out of the woods just yet. For more, we bring in Amanda Agati, who is the PNC Asset Management Group Chief Investment Officer. Amanda, great to have you here with us this morning. All right, help us break this down and your perspective here, why we're not out of the woods just yet.
Well, it's always nice to be with you. Thanks for having me, and good morning. I would just simply say that one data point does not make a trend by any means. And so the market really took the July CPI report as claiming victory that the peak is officially in. And while that might very well be the case, the market has rallied an awful lot, assuming that the Fed's forward guidance and ultimately the terminal rate assigned by the current dot plot is really where policy is going to ultimately end. And so I think we need a bit more in terms of data points to confirm that officially the peak is in. I think over the next couple of months, we can certainly get confirmation of that to the extent that CPI continues to move in the right direction. But we don't have confirmation from the Fed and Fed governors across the board that really the guidance that they have laid out is really it. I think the Fed is very much fixated on needing to do more, and that's a very vague term. And so the key question is how much more aggressive, how much more hawkish from here. If they go much more hawkishly than what the market has already priced in, I think that does create some downside risk given where valuations are sitting today.
Do you think we're overdue for a little bit of a pullback here?
I think it's possible, sure. The market really wants to move higher. You can tell by the psyche, certainly, of the market here over the last few weeks that it's just fixated on trying to get past a lot of the macro challenges and the concern around Fed guidance and just grind higher here. But I think over the balance of the summer, the high volatility regime is just going to continue to dominate. I think things are going to continue to be quite choppy until we get further confirmation of inflation peaking or rolling over and some stability in terms of that Fed forward guidance. It kind of all comes back to those two key variables.
Okay.
So I think it is possible to see a little bit of a pullback here.
So what would you think that the likelihood would be for what you've talked about as a perhaps Christmas wish for a Fed pause?
Well, it's no longer July, but I'm going to stick with my corny joke that my Christmas wish or Christmas in July for me certainly would be a Fed pause coming in December. The market's actually assuming a little bit over a 60% chance of a zero policy rate move in December, aka a Fed pause. And so for me, I'm still trying to figure out whether my Christmas wish is going to be granted or I'm going to end up with coal in my stocking. But I think if we got that Fed pause, that would be really positive in terms of a catalyst to get this market rally re-engaged and set the stage for a much more positive 2023. So that's where we're focused. I think it's less at the moment about individual rate hikes between now and the end of the year, and much more about where that terminal rate is going to land and whether or not we get that Fed pause. It doesn't matter from the market's perspective whether we get 50 basis points in September or 75. At the end of the day, of the destination, that final destination is kind of where the market has priced for. I think that's really good support for the market at these levels.
Man, and my Christmas gift, early Christmas gift, is a couple of some tequila I'll be having at happy hour tonight. I'm very excited about that. But look, you mentioned volatility in the markets. We're just seeing a lot of just wild swings, notably for companies that are losing money. What is triggering this?
Well, the high volatility regime has been absolutely a hallmark of this entire cycle since the onset of the pandemic. I keep saying hashtag high volatility regime, and everybody I talk to is like, when are you going to retire that hashtag? But I think, unfortunately, this dynamic is still going to be with us well through the end of this year into 2023. And I think it's much more a function of this market really struggling to assign value or price the perfect storm of macro headwinds that are swirling. And so when you see the companies that are really challenged from a fundamental perspective, those non-earners really see a lot of whipsawing here. I think it's a function of what is the backdrop ultimately going to be, and is it going to be supportive for the companies that are struggling the most here? Are we going to end up with financial conditions in overly restrictive territory? We're not there yet, but I think the market is really struggling to price value and assign value in this kind of a fuzzy perfect storm backdrop we have here.
How do you imagine that U.S. companies might continue to see growth challenges considering their annexation to or their reliance on revenues that may come in from EU countries as well, which are already trying to weather their own set of economic uncertainty?
It's something that we're watching very, very closely, but I would say just in general, US-based companies, even though they may be multinational companies, are absolutely the best position and best on the global block, if you will. And so we think that US domestic equities, US exposures are going to be very well positioned to the extent that growth continues to slow. On a relative basis, we think we're in better shape. That is, corporate America has more room or margin for error, if you will, from a profitability perspective to kind of weather this storm here. So definitely focused on the challenges in the EU. We don't see, a meaningful reversing of course there and a snapback in terms of underlying fundamentals. But I think other parts of the global economy are really seeing some meaningful signs of strength, and I think that's enough to keep them powering through.
Keep those investing hashtags coming, Amanda. I like them. Tweet them at me. I really enjoy it. Amanda Gotti, PNC Asset Management Group Chief Investment Officer. Have a great weekend. The House is expected to pass the Inflation Reduction Act, opening the potential to ignite some upside to clean energy suppliers. For more on what this means for the energy space is Rob Barnett, Bloomberg Intelligence Senior Clean Energy Analyst. Good to see you in person. Thanks for coming down.
Thanks for having me in the studio.
Let's start from the auto perspective, because we keep looking at the inflation protection bill and legislation, what it means to like a Tesla or Rivian. And I think Rivian went into great detail on their conference call last night. It may not mean much because of the caps on it. How big a problem is that?
Well, I mean, all of this stuff is very long lead time. And it's got this sort of rather almost Orwellian name, the Inflation Reduction Act. Is it going to do anything for inflation in the near term? It's really hard to say. And it is going to provide a demand boost for a lot of technologies, EVs, wind, solar, batteries, hydrogen. There's goodies in there for anybody looking at the clean energy space, but none of it's overnight. You got to think this bill is going to unfold over the course of 5 to 10 years kind of range.
Okay, and so last time we spoke, you were in the UK. You've been able to make your way over here. Thank you so much for joining us in studio. So with all of what we've seen play out in the region as well, we were talking about a heat wave back then. On the international energy front, where have things started to settle right now, and can that kind of sustain itself?
Well, so the world has actually changed a lot because of this Inflation Reduction Act. If we were talking about some of the names that we cover, sort of a First Solar, a Solar Edge, which makes inverters, SunPower, which installs solar panels, the median company in our solar theme basket was down about 8% at the mid-year. Right now, they're up about 13%. So we've seen this sea change, and it is being driven not just by the policy front, but by this tremendous sense of demand and by this energy crisis that we were talking about last time.
Yeah, Rob, I'm looking at a First Solar right now. Past month, of course, a lot of that reflects the reaction in the market after the act, up 65%. I mean, is that just too much? Or are these companies, these solar companies, going to see a boom in their business?
Well, I think from a demand perspective, the fundamentals look good. But if you're looking at traditional valuation metrics, EV, EBITDA multiple, these kinds of things, they're very stretched for a lot of these companies. Now, over time, we see these sort of names growing very quickly. So it's, can you be comfortable with a high valuation if the growth is there? That's the kind of calculus you're going through if you're looking at the solar space right now.
You mentioned a First Solar and some other solar names. You didn't mention Tesla's solar business, Solar City. Are they going to be a beneficiary of this?
Well, I think all of the solar exposed names can really benefit from that demand push. And one of the things that Tesla is doing, and all of their competitors are, is attaching batteries to the project when they're installing the system. So we're seeing tremendous growth on the battery plus solar business over the next 12 months. How
many years to make some of these investments real so that consumers feel them, so that businesses also feel the impacts of it as well?
Well, it's real today, and it's growing fast, but it's a multi-decade process to imagine really doing the energy transition. So in the near term, these are investments that can make a lot of sense right now, particularly if you're in Europe or a place with really high commodity prices. I mean, the gas price in Europe is over $60 per MMBTU. It's 8 and change here. We're talking about an 8x difference. So there's a lot of economic incentive to get these kinds of technologies in the ground.
So as a follow-up to that, because that would make the midterm elections, that would make even 2024 extremely important for continued investments, even when we're seeing the passing of the baton from elected officials as well. And so what do you expect to hear, not just in the midterm elections, but even as we go into the next general election, on how important some of these investments are?
Well, there's one more piece of the policy equation that's not being tackled in this so-called Inflation Reduction Act, and that's the permitting side of the equation. Now, the oil and gas folks, they want to be able to get their projects done. Guess what? The wind, solar folks, they also need help getting projects across the finish line. The hardest part of getting a lot of solar, wind, or oil and gas projects through is getting them approved. So if there's any easing on permitting, reducing that NIMBY complaint, it's a good thing for all energy developers.
I just keep going back to First Solar, Rob. And to your point, I mean, the PE ratio on this thing trailing is 65 times. That's almost 4 times the market multiple on the S&P 500. It's huge. But the supply chains for these solar companies, are they set up to handle this influx of what could be strong demand?
Well, we have seen a tremendous uptick in polysilicon, which is the input for the solar industry. It's what all the panels are made of. Last year, prices went up 3x. So a lot of folks are familiar with the price they're paying at the pump or gas prices even. Those are up a lot, but the input costs for the solar industry up 3x. Input costs for the wind industry, key component, steel. Steel is about 70% of the mass of a wind turbine. Steel prices are still up 2x compared with pre-pandemic levels. So they are wrestling on the profit side of the equation right now, despite that tremendous demand uptick. And so over time, one of two things will happen. Either we'll get those commodities back in check, or they'll pass those costs on to their customers.
Rob Barnett, Bloomberg Intelligence Senior Clean Energy Analyst. Thanks so much for joining us here today, Rob. Appreciate it. One other stat that we're actually keeping an eye on this morning as well, energy prices. I mean, that came up within this report as well. That downward trend providing welcome relief for motorists, but how is the highway rest stop coping with energy volatility and rising EV use? For more, we've got John Purchett, who is the Travel Centers of America CEO. John, great to have you here with us today. Just as we were breaking down some of the data here on consumer sentiment, continued declines in energy prices, where do you also see that playing into your businesses and within the rest stops, perhaps?
Sure. So first, so your viewers know, we're the largest publicly traded travel center company in America. We're in 40 states, and we serve both motorists and 91% of America's largest fleets. Remember the Fortune 500. Volatility for this business, and we're coming off of a huge quarter after 9 previous great quarters. Volatility in general, whether up or down, actually benefits us, and just a matter of a few pennies are very meaningful to our bottom line. So, we're still seeing a lot of activity on the freight side, meaning truckers, trucking, very robust. It's year over year stable for us, and that's coming off of a lapping couple of very strong years. And on the gasoline side, motorists are motoring a little bit less, but we've seen it again this quarter. We saw it most, really crystallize the inherent resilience of this business, where when one area may be a little soft, other areas pick up and lead to the results we just put up a couple of weeks ago in our earnings.
John, when gasoline prices come down, do you earn a better margin on those gas sales?
It's not that simple. No, we don't. It's really more a matter of the differences. And so when there is volatility, the difference between how we purchase and how we sell. And so long as there's movement up or down, we have opportunity. And one other thing just to point out, we tend to sell a lot more diesel than gasoline. So our performance is driven more by truckers trucking than it is consumers, motoring. We sell about 8 gallons of diesel for every gallon of gasoline.
In terms of kind of the cost inputs that you have to think about with your business, where do you need to make the most adjustments at a time like this, if at all, as we've seen a lot of other businesses need to restructure their own costs?
So we undertook a transformation, nothing to do with current conditions, a couple of years ago, and we really reorganized the entire organization. Now, to your question about how we're reacting to the current times, high inflation, potentially recession, we're really focused on ensuring we have a wide range of offerings, and we're famous for that, by the way. Our travel centers are larger, they have more food offerings, and we're making sure we're creating combinations, we're creating special discounts and incentives and other things, as well as just ensuring we have a range of options from lower cost items to others, as well as, again, offering combinations. That's really where our focus lies in the retail part of our business. And again, I think our quarter proved it's been successful so far.
And John, is inflation, I mean, we get that there are signs of it's peaking, but is it still so high that a trucker is opting for our Twinkie for dinner and eating out of their truck instead of going inside to one of your restaurants for a nice sit-down meal?
It's really interesting. To that exact question, truckers really, really care about having a sit-down meal more than, finding, on the cost side. When you think about it, when you're sitting in a truck all day long, you don't have any human real contact. It's maybe, voice sounds over a CB, which, by the way, are still used. So an actual sit-down meal matters a lot. And we're really the only company on the highway that is doubling down and remaining committed to sit-down full-service restaurants. The other companies who we compete against on highway have moved away from that. And that's been a real differentiator for us.
It's been a big year as well for infrastructure spending. Do you imagine that if there are more kind of highway projects to be undertaken in the coming years, that you're going to be ramping up or accelerating the number of locations that you have?
We're both partly because of policy and investing in incenting infrastructure, and separately just fundamentally to undertaking this 2.5-year transformation. We're growing very rapidly. We're very focused on acquisitions, acquiring independent travel centers and moving them into our network, as well as rolling through franchise, which I think we've signed about 49 new franchise locations since 2019. And I expect both of those to continue, separate from just organically improving this efficiency of the underlying business. But yeah, I do. I see a really, really bright future for us these next couple of years.
Will the Inflation Protection Act, will that help you in any way roll out EV charging stations to your locations?
There's a lot going on the government policy side from that, and there's something called NEVI, which is $8 billion of federal money being passed through the states. We're very, very focused on rolling out EV, although I want to make sure we're cautious and careful as Rob Barnett earlier said, on an earlier one of your earlier guests, this is a multi-decade rollout in terms of complete conversion, particularly on the heavy-duty trucking side. For EV, the grid's not ready for it. There's a lot of things that have to happen over a long time. But in the nearer term, we are very committed and are preparing to roll out EV in places like California, where utilization is going to be high very soon. It's starting already. And in other states where we expect high utilization. And then finally, areas that utilization won't be there, meaning people are not going to be consuming EV vehicles anytime really, really soon in proliferated scaled ways. We're going to be cautious in those areas. But most definitely, I do expect our behaviors to be influenced, and others, our industry, by government policy currently. So yes, we will be rolling out more EV.
Even though that is kind of a years-long process, what kind of, in your forecasting, what kind of net additive do you believe that will give to Travel Centers of America in revenue that you may see, or even margins?
It's really tricky to say because it's not clear, and the government needs to think about this. In different parts of the country, you can't, for example, resell electricity at all. In other parts, you can sell per kilowatt hour. In other areas, you can sell per unit of time. The private sector needs some clarity over, frankly, how it can make even a little bit of margin. That's directly on the re-energizing side. What we do expect, although it's a bit hard to financially forecast, is that dwell times, right? When somebody refuels with gasoline, they may be at our stop for 5 or 7 minutes fueling, maybe inside for a few minutes. On the EV side, you're there for 30 to 45 minutes. And those dwell times, we're focused very carefully on what do we do? What can we give our customers of the future to spend their time and to be more attractive, knowing these dwell times are different. Frankly, often when I travel a lot when I'm in airports, I look around often because you think about dwell times in airports, right? People are there, they have to be there an hour before. They're there about an hour. And plus, by the time you get through security, maybe they're 45 minutes. So there's some things we might be able to learn by how airports offer retail opportunities. And I think over the years, we're going to have opportunities to learn from places like that.
All right, we'll leave it there. John Perchik, Travel Centers of America CEO. Good to see you. Have a good weekend. If the U.S. is in a recession, it hasn't found its way to the boutique gym industry. Exponential Fitness saw second quarter sales rise 66% as people got their sweat on at brands like Club Pilates, Cycle Bar, and Row House. Operating profits rose to $17.6 million from $8.3 million a year ago. Joining us now for more on the quarter is Exponential Fitness founder and CEO Anthony Geisler. Anthony, always good to see you. Do you think the street has been too pessimistic on your business?
I believe so, and the industry as well. I mean, if you remember back when the pandemic happened, everybody thought that, we were going to stop working out in gyms and, Peloton was going to be the next wave. And obviously we've worked through that now. People realize gyms are back. Our members per studio are up. Our utilization and visitation per studio is up. Our average unit volume, per location is the best it's ever been. We raised guidance, so at 500 plus stores opening this year, selling over 1,000. We guided over $1 billion in system-wide sales. So, adding the UK, adding Japan, 2,350 plus stores in 14 countries operating. We didn't lose a single location during pandemic. We actually grew during the pandemic. And so Expo is doing very well. The industry is doing well. And so, we're happy with our results.
We saw earlier today in the initial reading for Michigan consumer sentiment that as we've seen some of the energy prices start to decline, that certainly has helped out with the consumer sentiment. And so, at least in this interim period of time, do you believe that that will actually contribute as well to those consumers who had said, you know what, I'm paying higher prices for groceries, I'm paying higher prices for gas, and I've got to cut out some of the workouts that I'm doing, or at least the boutique workout experiences that I may be doing and paying up for? Do you think that this will be an opportunity to re-engage them as some of those other necessity prices begin to come down?
Well, I would love to say yes, but the reality is we're on a subscription business. We have over 550,000 members paying on average about $130 a month. And so utilization is up, visitation is up. We didn't see a decline due to gas prices. So I don't know that we'll see an increase due to, energy being cheaper. Our members in boutique fitness are very sticky, and they've continued to stick with us through a pandemic, and they'll stick with us through, higher gas prices as well.
Anthony, you mentioned Peloton before. What happens to the at-home fitness industry? It seems to be, it has come up really, it has hit a brick wall. You have companies like Tonal laying people off, Peloton laying people off. What's the future for that?
Look, I just think at home will always be a part of what we've always done. I've told people that, my mom did Richard Simmons' Sweating to the Oldies when I was a kid,
My mom too.
So, it'll always be a part of what we do. And look, Peloton was a great source of fitness and introduced a lot of people to fitness during the pandemic. We're happy about that. We can convert those people into Cycle Bar members but at home is at home. It's not the community. It's not the experience that we deliver in boutique fitness. And so, it's very hard to compete with.
We were a Billy Blanks Tybo household over here, Anthony. And so, I don't know, some of those VHS cassette tapes are still around somewhere. But as we do think about those communities that you were talking about a moment ago, what are you hearing from those who are running the experiences in communities and even those who are prospective franchisees as well?
I mean, look, prospective franchisees are doing very well. Like I said, we'll sell about 1,000 new locations this year to new franchisees and existing franchisees that we have in our system. We'll open 500 plus locations. Like I said, AUVs are as high as they've ever been in the company history. So that means the average franchisee is making more money than they ever have, and utilization and visitation is up. So we don't have any KPIs right now that are flat or trending down. Everything is continued to exceed pre-COVID levels, which is what allows us to, raise guidance going into Q3.
Anthony, earlier in the week, we talked to Planet Fitness CEO Chris Rondo. He struck an upbeat tone, too, on the pace of his business. Have you talked to him? Is there any way your two brands can work together, maybe make some of your classes more accessible to that Planet Fitness customer?
Yeah, Chris and I text all the time. He runs a phenomenal business. I look up to him and what he does. And so, we're in constant contact. We're the two kind of, franchise fitness businesses on Wall Street. So we spend time together. But I don't know about Planet Fitness and Exponential doing anything together on that type of basis, but we're definitely in constant communication and continue to watch what he does.
Hey, Anthony, be sure to send him this video clip, all right? Every view matters.
Yeah, exactly.
So Sazi is being modest. He challenged Chris to a push-up contest.
We did some push-ups. Yeah, it was pretty funny. He was a good sport earlier in the week. I think we tied 5 push-ups inside of 4 seconds, so win for us both.
Chris is great, man. You got to look out. That guy's in great shape.
So. Yes, absolutely. That was Exponential Fitness CEO Anthony Geisler joining us from the West Coast. Good to see you this morning, Anthony. Appreciate it.
We were just kind of talking about the overall economic backdrop. We know that we got consumer confidence numbers this morning from the University of Michigan showing a turning around, perhaps, of how Americans are feeling. In combination with the other data we've gotten for July, how do you view the current economic environment despite those recessionary fears lingering?
Good morning. And yes, it is somewhat easing those recessionary fears. I think what was positive this morning was that the import price index showed a huge decline. So that does tell you that Fed policy, which has tentacles, by the way, globally, is working through the global system. And therefore, our imported inflation is going to start declining. And that's also showing up now in those consumer expectations. So as you recap the bond market, you see the 10-year yield edging a little bit down on those long-term expectations stabilizing, whereas the 2-year yield is up because it still has to follow the Fed's policy that's likely going to get a bit tighter from here. So if you take that all combined, it does show the market has gotten a little bit more benign about, yes, there's not going to be an immediate recession. We have high employment, we have strong earnings, but there's still a lot of inflation out there. So more tightening of policy needed.
Well, Ben, you talk about kind of tighter policy from the Federal Reserve. That is the indication that we've gotten from, for example, San Francisco Fed President Mary Daly saying that, quote, it really behooves us to stay data dependent and not call it, referring to a bottom, which maybe we've seen, or a top rather, in inflation. So when you think about just kind of Fed policy going forward, it is true, though, that volatility in bond markets is still very much present. We've seen some pretty big swings just so far this week. Do you have a projection on where you could see the 10-year going and what that tells us about the predictability of Fed policy?
I think it's an interesting dynamic at the moment in the Treasury markets that the 10-year seems to be sort of oscillating in this narrow range just above the Fed's long run rate. I think it's trying to tell us that the long end of the yield curve does believe the Fed will be able to reach that 2% inflation target over time, because, you know, at 2.5% neutral rate of Fed considers to be a 2% target. And that's what I think Mary Daly is pointing to, is to say we just cannot call it right at this moment. And therefore, this 2-year yield has to continue to move higher, probably towards where the Fed may end up at, just at 4% or about. So we can see a big inversion of the yield curve still ahead of us. But long-term rates are likely to be relatively stable, if not slightly higher. And I think this is giving the equity markets a lift, and financial conditions become looser as a result, despite we still have a lot of inflation.
So does that imply that you think that you won't see financial conditions tightening despite the fact that the Fed is not done yet raising rates? Because that's very much a part of the story here. If longer-term rates have essentially peaked already, then maybe that doesn't take any more steam out of, let's say, for example, the mortgage market or anything else that's hinged to longer-term rates.
Yeah, I think it's a fair point because, look, financial conditions have really loosened since mid-June on lower rates, particularly lower real interest rates, as well as a improvement of equity sentiment and somewhat lower volatility. And at some point, if financial conditions get too loose and it entices, again, a lot of spending and investing and a lot of momentum in the economy, and it doesn't therefore cool off inflation, then that will be something the Fed will really pay attention to. So there is something about real interest rates at this moment. They'll have moved above zero while financial conditions are looser. So I think the Fed will pay attention to that if they are feeling this getting too much in the direction that they want to, they will try to pull that somewhat back, those expectations. Nonetheless, I think the market is also trying to say that this is an environment where the economy isn't falling off a cliff. There's a rebound in the third quarter underway. The GDP now number shows that. And that's, I think, part of that, why markets are up. So a bit of a tug of war here, financial conditions, real rates, but it's something to pay attention to because ultimately it will lead to some sort of, I think, resistance in equity markets, some friction as real rates get higher from here.
Now, broadly speaking, how does that line up with the story that we've seen in the VIX, also known as the fear index? Because we know that has fallen below 20 as of this week. That, I imagine, is a factor in perhaps some of the elements you're talking about here. Do you feel like that is a confirmation that from an equity standpoint that we maybe did actually reach the bottom?
We could have. I mean, the VIX being at 20 or below is, complacency, if you will. And it comes along with just views about that we would hit a bottom at some point, a bottom. And a lot of skepticism how far this could reach now. But low VIX is low implied volatility, expectations that we're not going to see a lot of swings either direction. And therefore, it just is conducive to looser financial conditions. But I would caution, though, like you have a lot of technicals at work. There's something about positioning. There's a lot of shorts at the moment that probably getting taken out a little bit in an illiquid August environment. And at the same time, people pay really attention this year to the actual technicals like moving averages and trend lines and things like that. So I think that is still the market we're in, though, very technically traded to a certain resistance points. I would point to 200-day moving average, for example, on the Nasdaq, probably a big resistance point from here.
And then lastly here, I want to ask about meme stocks, because in your note you did say that there was a rally ahead of the CPI that could be a signal of something else. And it is indeed the case that Bed Bath & Beyond, for example, ripping higher. There has been a lot of retail activity over this week. Does that tell you anything about the macro picture?
You could think of it that way. You get, of course, people getting excited about investing again. And on the other hand, it's about companies that are retail oriented, that although sitting on large inventories and having to discount those inventories, retail activity may indeed be again picking up as gas prices go down. And that's some sort of a macro backdrop there against the fact that there are discounts, so lower retail inflation, spurring demand. Now, will that be just about Bed Bath & Beyond? Who knows, right? But I think the sentiment idea about the meme stocks is something of risk-taking, returning, while the economy isn't at a recession point at this moment. And I think that's a key thing to watch.
All right, Bed Bath & Beyond, perhaps into the macro as well. Ben Emmons, Global Macro Strategy Managing Director at Medley Global. Thanks so much and have a great weekend. Shares of Flutter Entertainment on the move this morning after the FanDuel parent company reported financial results for the first half of 2022. You can see shares up 14% on that stock. That included a positive profit for FanDuel in the second quarter. Joining us now for more on this, FanDuel CEO Amy Howe, as well as Yahoo Finance's Josh Schaefer. Great to have you on the program. Amy, sports betting market share in the United States accelerating to 51% in the second quarter. Tell us about what drove that.
Yeah, first of all, we're incredibly pleased with our second quarter performance. We did extend our leadership position to a 51% online share, and in 13 of the 15 markets, we had a number one position. It's really a couple things driving it. One is we have always been very efficient at how we bring customers onto the platform. We've always had a strong brand, but we've engaged phenomenal talent like Pat McAfee. We've got great integrations with TNT and Turner. NBA was a big part of Q2 this year. So that acquisition engine just keeps getting stronger and stronger for us every day. But our product is just phenomenal. We've been the number one downloaded sportsbook app for quite some time. And you see it in the way customers are engaging with our product. If you look at our NBA customers, 80% of those are using one of our parlay or same game parlay products. And it's creating a great experience. So it really comes down to more efficient acquiring customers and a really fantastic product.
Amy, I wanted to zone in a little bit on the profitability aspect there in the second quarter. That's obviously something we talk about a lot when it comes to all the different sports gambling companies. What do you think drove that? And is that something we can expect quarter over quarter moving forward, or with the addition of new markets and football season coming back up and those promotions, is that going to be something that kind of fluctuates quarter to quarter?
Yeah, I mean, listen, our Q2 profitability was a function of the player values were incredibly strong. And what we were seeing candidly coming out of Super Bowl is if you look at the relationship between our player values and our customer acquisition costs, that formula was great. So we actually decided to lean in. So that $22 million in EBITDA profitability is, despite the fact that we leaned in even harder than we would have. It's just a function of how many new customers you're acquiring relative to existing customers. And every year as your, existing customer base gets bigger, that flips to profitability. So we feel very good about as we head into 23, obviously this is going to come down to whether California gets legalized or not. But the fundamentals of our business and the fact that our value cohorts of customers are just getting stronger year over year. And the fact that we have phenomenal operating efficiency, right? If you look at over the last couple of years, our revenues have grown 2 times faster than our cost base. So for all those reasons, we feel quite confident about our ongoing path to profitability.
And I did want to ask you a little bit about those customers. We've heard from various different sectors across other businesses. There's concern when we talk about pricing pressures and where consumers are going to be spending their money over the latter half of the year. How are you sort of evaluating your consumers right now, and what are you expecting from them in the fall?
Yeah, it's a great question. As you can imagine, it's something that we're keeping our eye on. So far, as you can tell by the performance of the business, the fundamentals are very strong. And one thing you have to remember is an overwhelming percentage of our customers are what we would consider to be casual gamers, right? So their average bet size is not very significant. And customers are viewing this as a form of entertainment, right? So if we keep giving a great proposition, we feel confident that we'll maintain those fundamentals, but it's certainly something we're keeping our eye on.
And then, Amy, I want to ask just kind of about other ways that you're expanding the business. The news this week that, you've advanced kind of your plans to actually build a sports book in Las Vegas, a physical one. Why is that part of the strategy here? Isn't the whole point to go to digital?
Well, retail has actually always been an important part of our strategy. We operate 26 different retail locations across the U.S. right now. And what you see is that omni-channel customer, right, who's both engaged in retail and online sports betting tends to be a more valuable customer. It's an important part of, a relationship with our market access partners. And in Nevada specifically, we think that's the first right step. We have a phenomenal relationship with Boyd, who's our market access partner. So we think it's going to be a great opportunity to start to build a presence in a really important market.
Amy, when we talk about marketing spend and promotions and the promotions that users see on the platform, is that something that you guys are planning on? You mentioned leaning into it more. Are you going to continue to lean onto that in the football season in states like New York where the promotions have been big? Did you see success with that? And fans can expect that to come back come September?
Well, football is always the most competitive season, right? It is the number one acquisition moment candidly, for all sports betting operators. Separate New York for a minute. New York obviously has a much higher tax structure and almost all competitors have started to pull back. But candidly, even though we pulled back, we've still seen some strong fundamentals. I can't comment to what others are going to do. What I can tell you is that, we're always looking at that equation between the value of that customer and what it takes for us to get them on the platform. And as long as we see solid paybacks, within that 12 to 18 month range, we're going to keep spending in. But we're excited about our football product. It's our second year with our relationship with the NFL, which has gone extremely well. And our product is just fantastic. We have, by far the best offering around parlay and same game parlay products. So we're excited with NFL upon us.
All right. This is, by the way, a lot more calm of a backdrop than I think we had you on in the Super Bowl when Pat McAfee was screaming behind you. Remember that, Amy?
Yes, it is. It's much more calm than Pat in the background, but we love Pat.
Well, next time for the next earnings round, you could just have him sit behind you and just scream. That way we can get the energy up over here.
That would be a lot of fun.
FanDuel CEO Amy Howe, as well as Yahoo Finance's Josh Schaefer. Thanks so much and have a great weekend to both of you. Appreciate it.
All right, well, let's take a look now at how changes in the crypto landscape impact retail investors. Joining us now is Alex Adelman, Lolly founder CEO. So, Alex, how have users of your platform fared during this crypto winter?
Yeah, so people right now are looking to save money wherever they can, and we've created the easiest way for them to save money in the form of Bitcoin. So we've partnered with over 1,000 merchants that let you go both in-store and online to earn Bitcoin back on your everyday purchases. So for the last 4 years, we've made as easy as possible for people to get into Bitcoin. Now we're talking about all the institutions coming in, and we tried to give everyone a head start. Now the institutions are coming, and people need to stock up, I think.
What has that meant, though, when Rochelle sort of posed a question, just given what we have seen in terms of the pullback in crypto overall? What kind of traffic have you seen to your app?
Yeah, so I think unfortunately a lot of people they invest the wrong way. They invest through on the way up and at the top, but they forget about like dollar cost average investing, and so typically it's smart to go invest on the way down and on the way up if you believe in the technology and the asset. Me personally, I believe in Bitcoin and believe that it's a huge piece of the future. It connects 4.5 billion people with the same asset, the same technology, and so it's not going anywhere. And so if you believe in the technology, these things that happened over the last 13 years that have made the price go up and down are really meaningless. The technology is the exact same as it was. It's doing the exact same thing it was promised to do, and it's just as powerful as it ever was.
And Alex, this is a reward system that Lolly uses. So how does that correlate with some of the changes you've seen in prices with Bitcoin?
Yeah, so Bitcoin, we have a whole set of users who are your Bitcoin loyalists, your Bitcoiners, and they're trying to stack the dip. They're trying to get as many Satoshis, as much Bitcoin as possible. And so they don't care. It's a lot of the retail investors or retail individuals that maybe didn't have Bitcoin before, didn't believe in Bitcoin. They're harder to attract. But over the last 4 years, we've attracted over 500,000 people that want to earn rewards. So we constantly try to educate our users and teach them about Bitcoin so that they can weather storms where it does dip. And we really try to instill the principles of Bitcoin that are so important to hold on long term and to earn long term.
We were just pointing to some of the partners that you already have in place. Mm-hmm. What's been the reception from the retail side, retailer side? Because this is a partnership, and obviously, they're not taking the Bitcoin directly per se, but they got to be watching this volatility. I mean, is it easier for them to partner with an app like yours to create that cushion? What are you hearing? Yeah,
it's dead simple. I mean, we've one thing I've talked about is like we're trying to make the easiest way for consumers to get into Bitcoin, and we have done that. It takes 30 seconds. You start earning in no time. The thing that is sort of non-obvious is that we've also created the easiest way for merchants to get on board as well. So if you look at all of our 1,000+ merchants, there's less than 10 of them, not 10%, less than 10 of them actually accept cryptocurrency. So for many of them, we're the first crypto company that they've ever worked with. And that's like the non-obvious piece is like, it's so easy for merchants to get on board and attract a consumer that is interested in Bitcoin and be able to do it risk-free. Our users are not buying Bitcoin. They're just coming in and earning on their everyday purchases. And if you think about what merchants are actually optimizing for, they're optimizing for sales. So if they can use it as an incentive for you to go shop at CVS, shop at Ulta, shop, book your travel, booking.com, whatever you're looking to do, you're going to direct it because you want Bitcoin.
And we just had some pictures up there of some of the notable investors, including Serena Williams and Logan Paul. But a lot of them have been receiving backlash. Some of these, celebrities who sort of become the face of some of these crypto companies, especially at a time during inflation being high. People are like, should I get a cash reward? Should I try and turn to crypto? What do you tell them about really investing in this space and perhaps using Lolly as a way to get into getting some crypto?
So I've never seen any of our investors get backlash for Lolly. I think some people have said the wrong thing about things like NFTs. There's the whole scheme around what's called a pump and dump, and there's a lot. It's a very new space. So I think as with anybody, people are experimenting in public. The nice thing is that Bitcoin is this safe asset. It's never been hacked. It's very agreeable, and so all of our investors have been applauded for investing in Lolly and being aligned with a right now Bitcoin only company.
Really quickly, we had another piece of legislation come out last week in terms of the regulatory piece of this, specifically looking at the CFTC as the agency to oversee assets like Bitcoin as well as Ether. And your co-founder, Matt Center, came out and said, look, he believes this is the right move and it's actually good for innovation. Why is the CFTC the right agency to oversee this as opposed to the SEC?
Yeah, so I think that ultimately regulation, some form of regulation will be good. Operating like as a founder of a crypto company, as a co-founder of a crypto company, I think it's very hard to operate in gray areas. So when all the states are saying something different, when all the agencies are saying something different, it's very tough to innovate and to build. And I think that some form of recognition of what are the actual rules is good. I think that the most recent proposals, it shows that they have a lack of understanding of like the space and what they can and can't do. So there's certain things that you're just not going to be able to control. There's certain things, with like tornado cash, that's just, it just doesn't make sense to regulate and take away the human right of privacy. So there's certain things that I think are very frustrating to watch, but ultimately I think in the long run, they have to represent the people, and if the people want a private way of sending transactions anywhere in the world for next to nothing, the government can't keep fighting innovation. It can't fight a better technology, and ultimately it will lose to the people that they should be representing.
Well, the fashion world is still contending with impacts of the pandemic, but as the world returns to normal, shoppers are finding the items and the price points they need in the secondhand space. Fashion File CEO Ben Heminger joins us with more on that. Ben, we were talking about this today, that in the secondhand market, in many ways, you're kind of seeing a bump from both ends. I imagine consumers are seeking out more discounted items, but if you want to part with something to make a little extra cash, you've got the platform to do it. What kind of gains are you seeing on the back of these macro factors we've been talking about?
Yeah, re-commerce is definitely in a good spot in an economy like this, where there's some people needing to free up some cash and some people looking for a little bit better of a bargain. What we're seeing is an increase in engagement, an increase in desire coming into the re-commerce market, perhaps from the traditional retailers who sell similar luxury products. And the reason primarily, there's a few reasons, but I think right now, most interestingly, it's this cost insulation. The things that are driving prices on the primary market for luxury fashion are mostly supply chain driven, increased in international fuel prices, labor shortages, bottlenecks here and there. And when you have re-commerce, these items are already in the States, they're already here, they're already made. And you take out all of that other cost pressures that the supply chain provides, and you just have basic supply and demand economics that dictate the price, which makes this a great place. And we're really well insulated from some of the irrational, price hikes that are happening that don't have anything to do with the actual desire for the product.
So Ben, are you seeing stronger growth on the buying side or the selling side for your business?
I mean, it really is both. And I'm, not to make an easy answer out of it, but it's both. We're not seeing any real cooling off from the level of buying excitement that we had last year. Last year was 100% growth year for us. We've been around for 20 years, and last year was our biggest growth year ever, $430 million in GMV. And that same level of volume is sustaining today. So we're seeing a lot of that, a lot more engagement from customers than ever before, but also the demand to sell product to us is increasing beyond even last year as well. We're seeing no slowdown there.
You know, on that front, you recently made an announcement that you're setting up a 60,000 square foot authentication and center and showroom. I mean, that's a pretty bold move at a time when we're moving more and more things online. Is that a bet on the secondhand market growing even more? I mean, talk to me about that thought process on why you decided to double down on a physical space.
Yeah, well, yes, the 60,000 square foot space is in Chelsea in New York City, and it combines like an authentication center where we process the goods we authenticate them, we photograph them there, we store them there, and we ship them there. But what's the double down and the bet there is that we've seen a really high engagement level with the physical product when we allow a customer to come in and look at it, and when they go to New York and they see the space, like in the video showing it's similar to that, but you'll be able to see the 30,000 different items that we have with your own eyes, and they'll be able to buy them in person. And I think that it's that personal engagement with the product that customers are craving right now. And we've got good evidence from our other location in Carlsbad, California, that when people come in and engage in person, conversion's higher, the sale prices are higher, and the enthusiasm and the retention is much higher. So that's happening in Carlsbad on a great way. That was enough proof to say, if you put this in New York City, how could that not be a great experience for our East Coast customers? And so far that's proving out, and it's open for the public today to come in, and it's a fantastic space.
And obviously, there are a lot of re-commerce companies out there. You have, RealReal, you have Poshmark, where it's sort of consumer to consumer without a middleman. But then, as you mentioned, this issue when it comes to authenticating some of these goods. So how does Fashionphile plan to differentiate itself from the competition?
Well, being an expert, when you're in the industry of ultra luxury fashion, because we only take things that are handbags, accessories, jewelry and watches. And we're experts in those things, and we can authenticate them. So that's a differentiator right now, that you have the, true confidence and a lifetime guarantee on authenticity and quality that we stand behind. But the other big differentiator is that we do a buyout model. So you come to us and you can get paid the same day if you come into one of our locations, or if you go online, you get paid as soon as we get the item and authenticate it. So the direct buyout model, I think, has been a differentiator that's been really good, allows us to curate some of the best inventory in the industry. That's been a big one. Plus the fact that we curate high, in the kind of the high price point, allows us to have a high enough, average sale price and unit economics to make re-commerce profitable, which has been hard for other, I think, people in the space to try and make it profitable. If you don't have, it's very costly to do re-commerce. You got to take each item in, you've got to look at it, you got to inspect it, you got to clean it. And that cost needs to be made up for in a fairly high, gross margin. And the only way to do that we've seen is to stay in the higher sector of retail. So that's working well for us. Those are some of the differentiators.
In this episode of Influencers, New York Congresswoman Alexandria Ocasio-Cortez.
Capitalism at its core, what we're talking about when we talk about that, is the absolute pursuit of profit at all human, environmental, and social cost. A lot of these price increases are potentially due to just straight price gouging by corporations. If we just allow a full just continuation of student loan payments, we are talking about a catastrophic development for millions.
Hello everyone and welcome to Influencers. I'm Andy Serwer and welcome to our guest, Representative Alexandria Ocasio-Cortez. Representative, nice to see you.
Thank you so much.
I know you want to talk about student debt and some other issues as well, but before we get to that, I want to ask you about inflation and interest rates and Fed Chair Powell, who recently said that the strong labor market made it appropriate for him to soon raise interest rates. I wonder what your take on that is.
Well, I think particularly when we have this conversation in the context of inflation as well, it's really not just labor, it's not just rising wages, but there's a lot of different dynamics that I think are contributing to the increase in prices, whether it's supply chain complications, yes, labor issues, but sometimes lack of labor, a lack of the ability to be able to work consistently in their jobs, which is also tied to pandemic controls. And also, there's a real distinction to be made between inflation and price gouging. And there's a lot of evidence that particularly industries with high concentrations, corporate concentrations, whether it's almost oligopoly level industries, a lot of these price increases are potentially due to just straight price gouging by corporations.
Are you concerned about inflation and higher interest rates and the impact on working people?
I mean, wherever prices are increasing and it's making it difficult for someone to be able to feed their family, that is always going to be a major point of concern, a primary point of concern. But the real key is making sure that we're diagnosing the causes correctly, because the danger here is that if we say we're helping working people too much and say that the cause of this is, oh, it's because we provided too much assistance during the American Rescue Plan, stimulus checks were too generous, that is why we are dealing with the problems that we're dealing with now. What that's going to result in is a pullback in the assistance that some families need the most right now. And when we already talk about the cessation of the child tax credit with the failure to pass the Build Back Better Act before the end of last year, we really need to be very careful about diagnosing these issues correctly. Because on the flip side of that coin, if we say there are real antitrust issues here, there's a lot of corporate abuse of power leading to price gouging, then that allows us to pursue lanes such as antitrust and also pursue labor protections, COVID protections that can help people get back into the workplace and stay safe in the workplace.
Right, and so you are seeing those who are suggesting that it's because of the assistance that people had during COVID that's inflationary and therefore we need to swing the pendulum back.
Yeah, and I couldn't disagree more.
Right.
I couldn't disagree more with that assessment.
Student loan debt, and I know you've called repeatedly for President Biden to forgive student loan debt. Why hasn't that happened, and what do you think will happen if the pause that exists presently is allowed to lapse?
Well, I cannot understate the danger and the risk economically, politically, and just where we are right now as a country of allowing the moratorium on student loan payments to lapse in May. If we just allow a full just continuation of student loan payments, we are talking about a catastrophic development for millions, the over almost 50 million student loan borrowers in this country. There were millions of student loan borrowers that were already defaulting going into the pandemic. But more than that, we are at such a delicate point in the financial and just general economic recovery post-COVID that to then restart payments that are essentially the size of a mortgage payment, sometimes even larger, on a generation that was already so devastated, not just by this, but the recession, et cetera, I believe it could very it could throw out of balance already what is a very fragile recovery. And not only that, but this forgiveness is forgiveness is the just thing to do. It's the right thing to do. Why the president hasn't done it yet, I'm not sure, but I do think that this is an issue of increasing urgency. He has already indicated an openness to it, and he has actually already used his authority to forgive student loan debt in certain small, very narrow cases.
Because there are people who suggest he doesn't have the authority. Is that a legitimate argument or just maybe a smokescreen?
I don't think it's a legitimate argument. We've seen him use the same legal authority that the president has used to suspend student loan payments is the same authority that he would use to cancel them. And not only that, but he has used that authority. He has indicated a willingness to use the authority. And I think that it would be extraordinarily important and urgent for him to do so.
And what about the argument that it's a moral hazard? In other words, you're letting people off the hook by forgiving the debt.
Well, what I think is the true moral hazard here is the surging costs of education in the United States. What has actually created the moral hazard is this guarantee of saying we will issue minors hundreds of thousands of dollars in student loan debt at almost any level with almost no limit, and we will allow colleges and universities to dramatically increase the costs of their tuition with the guarantee of that loan value on 17-year-olds. So what is the actual true moral hazard here in the situation is the controls on the cost of education in the United States. And one very important control in this, to that note, is tuition-free public colleges and universities. Because then what that does is that it introduces competition into the market to which private universities have to actually meet a lower baseline. But people act as though it's just fancy public schools that are extremely expensive now. But public college tuition has also increased dramatically far beyond the pace of inflation.
You have a huge social media following, obviously, and a big platform. Have you been either surprised by how much or how little influence that affords you in Congress? In other words, how does that translate, Representative?
That's an interesting question. I think it's the way that I've thought about it, first going into office and then continuing, is that in Washington, there are a lot of different sources of power. There are some members who have extraordinary connections to different power players, different power centers that are very well connected and networked. There are other individuals who are very, frankly, financially connected. Industry, lobbyists, corporations throw their weight and donate and give their influence, their lobbyists, et cetera, throw an enormous amount of their support behind other members of Congress. So every single member kind of has their assets that they lean on. And for me, I decided early on, because I don't accept money from corporations, I do not take meetings with lobbyists, I am not well connected, I don't come from a well-connected family or community or anything like that, that my ability to navigate and advocate is going to have to be squarely rooted in relying on everyday people and their support and my ability to communicate with them what is going on in Washington.
It's an interesting perspective. You self-identify as a democratic socialist and have called capitalism irredeemable, I believe. But what does that really mean? And does that mean capitalism should be eliminated? And are your views compatible with capitalism?
Well, I believe that in a broad sense, because when we toss out these big words, capitalism, socialism, they get sensationalized and people translate them into meaning things that perhaps they don't mean. So to me, capitalism at its core, what we're talking about when we talk about that is the absolute pursuit of profit at all human, environmental, and social cost. That is what we're really discussing. And what we're also discussing is the ability for a very small group of actual capitalists, and that is people who have so much money that their money makes money and they don't have to work. And they can control industry, they can control our energy sources, they can control our labor, they can control massive markets that they dictate and can capture governments, and they can essentially have power over the many. And to me, that is not a redeemable system for us to be able to participate in for the prosperity and peace for the vast majority of people.
So people talk about stakeholder capitalism, right? Like Larry Fink at BlackRock, where the weighting for different constituents besides shareholders is more equal. Is that something you'd be amenable to?
Well, I think at the end of the day, it is about who has control over the very core assets of production in society. If it ultimately comes down to a billionaire or the Koch brothers or the Koch family having control over the vast majority or large plurality of our oil assets in the United States, if it's a handful of very wealthy families having control over, private families having control over means of production, that is essentially the capitalist system that we live in. It is a small group that is of privatized control over what we eat and how we fuel our society. Now, where we can transition to, and there are certain ideas where we're talking about, for example, Elizabeth Warren has discussed workers being elected to the boards, governing boards of companies, and also, we're here in the Bronx. I represent a community that has the largest concentration of worker cooperatives in one of the largest concentrations in the world. Now, these are alternative ways of doing business. Free markets are not the same thing as capitalism. And you can have markets where businesses and ways of producing, trading, selling goods are are really controlled, and not just controlled, but given more power to workers. People get a fair shake. Union jobs, unionized workplaces. All of these are different steps and levels that we're talking about in a more just economy.
Congress people trading stocks. You have come out calling for a ban here. And I wonder, and there seems to be some momentum, but I wonder why this seems to be such a difficult thing to pass. And is Speaker Pelosi a roadblock here?
Well, you know, it's not really a mystery to me why it's difficult to pass. An enormous amount. I wouldn't be surprised if it was a majority of members of Congress hold and trade individual stock. I don't know the actual numbers, but it is a very large degree. And you know, the key here is that it's not to say that you can't have a retirement fund or a college savings account.
Or a blind trust.
A blind trust,
right.
a mutual fund, an index fund. These are vehicles of investments that are broad that individual members of Congress don't have direct control over. But even last year, there was at least 75 members of Congress that held individual stock in Johnson & Johnson, Moderna, and Pfizer. And we're talking about in the last 1 to 2 years. And so that is where we should be drawing the line. I am a member of Congress. Members of Congress have access to very sensitive security clearances. We have access to very detailed, tailored briefs. Our job is to try to anticipate and legislate for what we see is coming. And we should not have the ability to both have access to that information and be able to hold and trade individual stock. And that's really what this is about. It's about our ability to direct and hold trades in individual stock with access to the sensitive information that the public has given us.
Voting rights reform. Is that a dead issue? It's tied to the filibuster. Joe Manchin, Kyrsten Sinema have come out against it. What is your take on where that stands?
You know, this is, I think, one of the top level questions and issues that we have before us in Congress. I very much believe that we are at the precipice of a return to Jim Crow style laws across the country. We're already seeing these wheels in motion, attempts in Texas and Georgia and across, across many different states, attempts at voter suppression. And frankly, what Senators Manchin and Sinema failed to recognize, and what is disappointing and sad to see, is how ahistoric their stances have been throughout this debate.
What is your ultimate objective when it comes to those big tech companies, Representative?
Well, when you look at a company like Facebook, you can't kind of put them all in in the same boat. They do different things. But when you look at a company like Facebook and the completely corrosive ways that they have exercised an abuse, I believe, in civil society writ large, not just our democracies, but you look at, for example, what we're hearing from other countries when we talk about production of vaccines or perhaps like what we can do to export, help them. They say it's not just, there are some things that the United States provide that are welcome. There's also things that we want the United States to stop exporting. And one of those things is disinformation. And disinformation through US founded companies like Facebook that have absolutely slowed and frankly sabotaged the global effort to fight against the coronavirus. And we see this disinformation used both in the public health sphere. We've also seen social scientists have truly shown the impact that Facebook has had in contributing to social violence and perhaps even accelerating large-scale, very dangerous, and some would call genocidal activities in places like South Asia, et cetera, human rights abuses, and also hate here at home.
But I'm curious, what do you think we should do about them, or what we should do to them, I guess?
Facebook should be broken up. We should pursue antitrust activity on Facebook, and there are so many different reasons why. They are acting as an advertiser. They are acting as both platform and vendor. They are a communications platform, which has historically been a well-established domain of antitrust. And so because there are so many businesses and industries in one, the case is, I believe, right there in and of itself as to why they should be subject to antitrust activity.
I want to ask a couple personal questions about you. I'm teaching at Columbia this semester, and one of my students, Penny Ramirez Fernandez, wanted me to ask you, how did being a waitress help you understand the American economy, its successes and failures?
Well, I mean, I believe that my time as a waitress is the most politically formative experience that I had. It's that, along with just growing up in a working class family, experiencing just the ravages of the Great Recession, almost losing our home, all of that. But particularly the years that I spent working in restaurants. The thing about restaurants is that it really is such a crucible of so many different public policies. I worked alongside undocumented workers. I didn't have health insurance. I tried to buy Obamacare, the ACA, Affordable Care Act. I actually used and relied on the policies that were coming out of Washington. And I worked, I was a Senate intern back in college. I got an economics degree. I worked in public policy spaces. I also had worked for nonprofits. There is an ocean of a difference between the white papers and the policy you see on paper and how it's experienced by everyday people. And unless you actually go on to the exchange and try to buy healthcare for yourself and use that healthcare and understand how it's serving you and how it's not serving you, it's very difficult to understand why so many people are frustrated by otherwise well-meaning, sometimes democratic policy.
As a former dishwasher, I can relate. So I want to ask you maybe a kind of funny question about the moniker AOC.
Okay.
So is that what your friends and family call you, or when did that sort of evolve? When did you become AOC?
I actually think it's funny enough. AOC really emerged after I won my primary, And I think there were a lot of pundits on television that were kind of like stumbling, because my name is Alexandria Ocasio-Cortez. And when it was the news story after I won my primary was so sudden. And there were just all these folks on TV that I think were kind of like struggling to say my name, that it actually started coming from TV. And so, you know, in the past, there were some folks that would sometimes say it like jokingly, but it was never a nickname that stuck. But I think it actually kind of came from media pretty overnight, but my friends don't call me that. The folks that I organize with,
Do they call you Alexandria?
they'll call me Alexandria, or they'll call me Alex. My friends will call me Alex. But yeah, it's you know, it's shorthand, but I now embrace it, welcome it, accept it.
And final question, maybe it's too early in your career to ask this, but I'm going to ask anyway. How do you see your legacy going forward?
You know, I always feel like, I actually think that it is important for young people to ask themselves questions of legacy very early. And I think the reason that that's important is because we shouldn't root our legacy in a position or a job or a role, but we should really root it in a mission of what we want to do qualitatively and how we want to be remembered. And I don't think it's ever too early to consider that, because it helps us make decisions, it helps us root us in our values and our morals. And I just hope that for me, you know, what I do and what my community understands and receives and feels from me as their representative is someone that always puts the people of this country first, that doesn't allow herself to be dissuaded or distracted by power, influence, etc., and that we are dissuaded and relentless and honest and authentic in our pursuit for a better world. And that, you know, that in that pursuit, we just tell it as it is and try to do everything we can in every moment that we can. And I think that's pretty much it.
That's it. Representative Alexandria Ocasio-Cortez, thank you so much for your time.
Of course, thank you so much.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Welcome back to Yahoo Finance Live on this Monday morning. I'm Brian Sozzi here with Brad Smith and Julie Hyman. Markets have lots to digest this morning, including an interest rate cut out of China, but all eyes will soon turn to results from big-name retailers like Target, Walmart, and Home Depot later on this week. Right now, we're seeing some mixed action across the board. Nasdaq has turned slightly green, though. Now, here are three things we're watching for you right now. Yahoo Finance contributor Kevin Cirilli will tell us what he's watching on Capitol Hill following the president's Inflation Reduction Act win. Shares of Plug Power are making a U-turn back to January levels as the Inflation Reduction Act awaits signing by President Biden in D.C. The bill would provide billions in funding and tax credits to the hydrogen economy. Plug Power CEO Andy Marsh joins us soon to chat. And we'll check in with Getty CEO Craig Peters as we welcome the 27-year-old company back to public markets. Its shares have caught a bid after completing a SPAC merger at the end of July. Brad, over to you.
All right, you mentioned some of the major averages. Let's take here a look at some of those major averages for the Dow Jones Industrial Average right now. Still flat, just barely to the downside, about 31 minutes into trade here on this Monday as we kick off a new trading week. The Nasdaq Composite, though, you mentioned that that's barely in positive territory, and that's exactly where we find ourselves right now, up just about 7-ish points there. So we'll see if we can hold on to that and perhaps build on some of that move higher most recently here this morning in that slight candlestick higher. And then additionally, just checking in on the S&P 500, you're also seeing that right now in negative territory. So mixed right now and hyper oscillating for some of the major averages, but for the S&P 500 down by about 0.1%. Want to take a look at the heat map here real quick to see exactly where we've got some of the biggest movement taking place here today. I've been keeping an eye on some of the semiconductors here. You're seeing NVIDIA having a decent day thus far. It's up by about 1%. Also AMD up by about 0.5%. But then additionally, as we start to get into some of the other big tech names here, you're seeing even a name like Tesla here on the day. TSLA, that is up by about 2%. Some of the other major movers shouting out Moderna here as we keep a close eye on that. Shares popping there by about 4% on today's activity. And then additionally here, let's also just take a look at Gilead as well, rounding out some of the broader biotech space. You're seeing that up by about 2.7%. So keep a close eye on some of those names as we move on throughout the rest of today's trading activity. You could see them trending on the Yahoo Finance platform as well online. Everyone switching gears here. Last week's inflation reports came in softer than expected, but we're still far above the Federal Reserve's 2% objective. Our next guest says that the Fed has plenty of runway beyond 2022 to rein in inflation. Hugh Johnson, who's the economist and chief investment officer over at Hugh Johnson Advisors, joins us now. Hugh, great to have you here with us today. Help us break down and add perspective to what you're seeing play through in the markets and what exactly the Fed pathway may be going forward from here that the markets will still have to digest over time.
Well, what I think or hope that we'll see from the Federal Reserve is certainly not what we're hearing from members of the Open Market Committee or what they think is lies ahead. You know, obviously we got the good inflation numbers that we had for the month of July. I think you should keep in mind that the month of August are going to be equally good. In other words, inflation numbers are going to be soft. And probably for the coming months, they're going to be soft. When we get to the end of 2022, we're going to be looking at, say, 6.5% to 7% year over year numbers. And when we get into 2023, they're going to be materially lower than that. In addition to that, some of the signs we're getting from things like the leading indicators tell me that the economy is in the process of slowing. You're not going to see employment numbers that are as good or strong as we saw for the month of June and July. What you're going to see is the numbers are going to be coming down pretty swiftly. So we're going to have soft economic numbers. Now, what I would like to see is that the Federal Reserve, this gets reflected in Federal Reserve interest rate decisions. But when you listen to what they're saying, members of the Open Market Committee are saying they're just as hawkish as they've ever been. And they're going to continue to raise interest rates continuously until they get that rate of inflation down at 2%, which I don't think they can do, but nevertheless, they're very intent on doing it. So the Federal Reserve is saying right now that they're going to be more hawkish than I think they should be. And when we get into 2023, when we start to see really soft economic and inflation numbers, we'll just see what they do.
So Hugh, you think this is just wishful thinking, this view that has become embedded in the market of a dovish pivot by the Federal Reserve? If you take seriously what they're saying, you certainly would say that's probably a pretty dovish view on my part, or optimistic, or too optimistic a view, and that they're not going to pivot, or they're not going to pause, or they're not going to go a little bit easier on raising interest rates, particularly when we talk about September. You know, there's still people talking about 75 basis points. I think it'll be 50, and talking about 50 basis points in November. I think it'll be 25, December 25. They say they're going to be as tough as they've been. I don't think so. I think they're going to come off of that. Otherwise, they're risking the same mistake that we see so continuously in financial market history of, you'll remember the word overkill. You might hear that word again.
Well, and their mistake going into this was on the opposite side, right? That they were sort of too late to begin raising rates when we were starting to see signs of inflation. So what gives you the confidence that they're going to be, that they've learned, I guess, from that mistake of not being responsive enough in the past?
Julie, that's a great question. It's when you listen to what they're saying, it tells me that they're going to be just as hawkish or make some of the mistakes that they've made in the past. When they talk about the importance of a 2% inflation rate, look, if inflation gets down to 2.5%, and you're a member of the Open Market Committee, and you're seeing very soft economic numbers, very soft inflation numbers on a month-to-month basis, what are you going to do? You can either be humane or you can stick to your guns and say it's got to be 2%. If you stick to your guns, and they've done this in the past over and over again, stick to your guns, then obviously we're going to have a risk of a very, very hard landing. Keep in mind, Julie, index of leading economic indicators have been down 5 successive months and are telling us that we've got a real risk of a hard landing. The numbers we're looking at for the quarter-to-quarter numbers for the next third quarter, fourth quarter this year, first, second next year, we're looking at numbers like 0.9, 0.7, 0.6. That's pretty close to a hard landing. And then you've got to be a little bit sort of flexible, shall we say, or responsive to the inflation and the economic numbers that we're going to see for the remainder of 22 and the early part of 23. They've got to be flexible because otherwise they're going to make a mistake.
Do you think that on the pathway to their inflation targets, they can maintain the employment situation that we've also seen?
No, you're not going to see the employment numbers that we've seen, I don't believe. In other words, we're not going to see numbers that come down a little bit from the prior month, but not a whole lot, and they maintain real strength. Look, at the employment numbers are going to come down, and I worry. Look, everybody forecasts these numbers, and everybody forecasts them differently. I see numbers that are pretty close to average monthly gains in non-farm payroll employment of 100,000 per month, and maybe even less when we get into 2023. Those are not very good numbers. So I don't believe that in their pathway to 2% inflation that they're going to be able to, at the same time, maintain or keep employment numbers on a monthly basis up. We'd like to see them at 150 to 200,000 like they were before the pandemic. I don't think they can do that based on what they're going to do right now. I don't mean to be very negative, but I must admit I'm very concerned, and I'm obviously familiar with financial market history, and I've seen all the mistakes that they've made, and I see the rhetoric being very consistent with the mistakes they've made in the past.
So just quickly, Hugh, what are the implications of all of this for stocks?
You know, that's the interesting part, is that if they do what I think they're going to do, if I think they're going to, I don't want to use the word cave, but give in, I think in time we're going to start to see numbers that say that the economic slowdown, we'll call it a soft landing or hard landing recession, is going to turn for the better, that things are going to start to improve. We're going to have a recovery. The stock market under those conditions will start to discount 2023, the earnings for 23, the earnings for 24, and the stock market will do better. That's like a normal cycle. But what has to happen for that cycle to resurface is that we have to see the Federal Reserve be flexible or try to get the soft landing that they say they want to get. They have to be flexible. Otherwise, we're not going to get much from the stock market. If we do get that, we'll get something from the stock market and watch the consumer discretionary and technology stocks under those conditions.
We'll be watching all of that. Hugh, it's great to get some time with you. Good to see you. Hugh Johnson, economist and chief investment officer at Hugh Johnson Advisors. Good to see you.
Pleasure.
Well, fresh data from the retail sector could be the latest catalyst for markets. Here's Yahoo Finance's Alexandra Semenova with what we're watching this week on Wall Street. We've been talking a lot. We're really excited about these retail numbers.
Yeah, news out of the retail sector could be the latest data to drive markets higher this week or, of course, lower, depending on how things go. A series of better than expected economic prints recently have really lifted sentiment on Wall Street. So investors will be watching the Commerce Department's July retail sales report closely on Wednesday, and we're expecting to see some moderation over the month due to lower gas prices. But core retail sales activity is expected to hold up over the month and show that consumers continue to spend money despite the inflationary pressures that they're facing. And of course, we also have a number of major retailers reporting earnings this week. Walmart, Target, the Home Depot, Kohl's are just some of the names on tap. And needless to say, traders are getting ready to be unimpressed by the numbers, expecting to see continued pressure from inflation on their margins. Walmart will set the tone tomorrow before the opening bell, coming just weeks after the company slashed its outlook and also announced plans for layoffs. We're likely to see more information on that theme as well as in other retail peers. And two things to look out for, of course, are what companies are saying about their built-up inventories as some consumers have cut back on spending, and what they're saying about back-to-school season, which could give some retailers a much-needed boost. And as if investors don't have enough on their plate, we'll also get minutes out of the Federal Reserve's last meeting this this week, and it could offer some insight about what policymakers are thinking for this fall and whether we've seen peak hawkishness with that last 75 basis point hike.
Yeah, that Coles quarter could be tough to look at, but we've had a rally. Despite all this bad news, stocks have caught a bid from the lows. What are you hearing from folks?
Yeah, well, we just saw stocks cap their longest winning streak since November. The S&P has now recovered about half of its losses since plunging from its all-time high in January. So there's reason to be optimistic about this rally, but Wall Street still appears to be torn about this. JP Morgan says that it's going to be sustained for the rest of the year, whereas Morgan Stanley coming out and saying that this is just a pause to the bear market, that the same headwinds remain, economic pressures, worries about the Federal Reserve, inflation, all of those things will continue to weigh on stocks for the rest of the year.
Alexandria Simonova, thanks so much.
Thank you, guys.
All right, we're keeping an eye on shares of Apple as the company's ticker page in Yahoo Finance is seeing strong traffic. The attention comes on a Bloomberg report that Apple may start pushing ads to other services such as Maps in a bid to boost profits. The company already offers ads on its App Store, news, and stock services. Apple didn't return Yahoo Finance's request for comment on the report. Apple shares are up 6% so far in August, outperforming the Nasdaq Composite's 5.3% gain. Coming up, the gusher in oil prices led to a banner quarter for Saudi Aramco. Julie's back with the numbers and a rundown of the top headlines this morning. Next.
Other headlines we're watching right now. Saudi Aramco saw a 90% jump in quarterly profit, marking its highest quarterly net income since going public in 2019. The profit happening, of course, on the back of higher crude oil prices as Saudi Aramco generates billions in cash for the Saudi Arabian government. In the second quarter alone, Saudi Arabia's GDP grew 11.8% year over year. By the way, Aramco also did not raise its dividend as a part of this big earnings report. Tesla has officially passed the 3 million vehicle mark for production. That's according to a tweet from CEO Elon Musk. Musk congratulated the Giga Shanghai factory for making its 1 millionth car over the weekend. This follows months of shortages and lockdowns in China due to the country's COVID policies. In July of this year, Musk said the Fremont, California factory had produced 2 million cars. Facebook users will soon be able to order food delivery from Facebook Marketplace. That's thanks to a new partnership between Meta and DoorDash. The two companies said they have already tested services in several U.S. cities, but that the partnership is still in the early stages. This is the latest bid by Meta to get more young people to use Facebook Marketplace. Brad?
The U.S. is coming up on the anniversary of the Afghanistan withdrawal. For more on why this is significant for the Biden administration and what the situation is 1 year later, let's bring in Yahoo Finance contributor Kevin Cirilli. Kevin, help us break this down.
Yeah, it's the 1 year anniversary following the United States withdrawal from Afghanistan. And quite frankly, the Biden administration is getting bipartisan criticism, something that's pretty rare. Now, the top Republican on the House Foreign Relations Committee, Mike McCall, Republican from Texas, he was on the Sunday shows over the weekend, Face the Nation on CBS, and he said, quote, "There are many sins, if you will. There was a complete lack and failure to plan. There was no plan, and there was no plan executed." Now, this is important because he just came out with a report in which he found that 70,000, let that sink in for a second, 70,000 Afghanis are still in Afghanistan and have applied for a visa, a U.S. visa, to get out of the country. Now, Adam Schiff, he's a Democrat from California, chairman of the House Intelligence Committee. He has also said that there are questions that need to be answered regarding the withdrawal from Afghanistan. However, he did point to some of the success that the Biden administration has had, particularly for the killing of the terrorist Zawahiri, in terms of getting that executed. And it shows really the precise ability for the U.S. military to take a target out.
And Kevin, you're also still watching Taiwan.
Yes, and just over the weekend, we got news that another group, a bipartisan group of lawmakers, has touched down in Taiwan. This, of course, after Speaker Pelosi's historic visit, and as the Chinese Communist Party continues to hold military exercises in the Taiwan Strait. This was led by Senator Ed Markey, a Democrat of Massachusetts. He was accompanied by Congressman John Garamendi, as well as Don Beyer, as well as another group, a handful of other lawmakers. But it also comes following the news over the weekend that 5 Chinese companies are going to delist from the New York Stock Exchange. And as reportedly, President Xi of China wants to hold, get this, a face-to-face meeting with President Biden sometime in November. Now, Xi Jinping hasn't traveled in nearly 3 years as a result of those zero COVID lockdown policies in China. Obviously, Xi and Biden have a lot to talk about in November, and that's going to be carefully watched. Now, the Biden administration has said that this did come up in their last phone call, but so far, no official concrete plans for the two leaders to meet. But they're talking about meeting, so I guess that's a step forward.
Yeah, it'll be interesting to see where they choose to do so, to your point about travel. From China to Wyoming, where tomorrow incumbent Wyoming Congresswoman Liz Cheney is going to defend her seat against a Trump-backed opponent in the Wyoming primaries. Why is there so much attention being paid to this race? Why is it so significant?
Well, this is, it's like Yellowstone meets House of Cards, okay? No one really expects for Congresswoman Liz Cheney to defeat MAGA-backed candidate Hageman, but it does set up the contours of the next 2.5 years, especially in the 2024 presidential primary. Now, I did speak with a prominent Republican bundler just the other week who said essentially to me, Liz Cheney inherits those independent voters who left the Republican Party, who are deeply, deeply skeptical of what the Trump base, so to speak, has done to the Republican Party. These are fiscally conservative voters. These are voters who are very worried about America's standing in the world on geopolitical issues. And they are folks who really want to see the Republican Party get out from under the grip of the fringe movement, as they would describe it, of conservatives. But regardless of what happens in Wyoming, don't forget about Alaska, because Kelly Tshibaka, who is another MAGA-backed candidate, she's running against Senator Lisa Murkowski, perhaps one of the most influential Republican moderates in the Senate. But this is where it gets really interesting, Julie, is because Alaska has those ranked choice voting. So even if Murkowski finishes second behind Tshibaka, she would still be able to get to a primary and honestly would have a much better chance because they've changed their primary rules. This is an interesting bellwether and a case study, so to speak, because the way that Alaska has modeled their primaries could actually end up being how other states follow. So keep an eye on Alaska as well. So, I got to say, I do kind of miss these primaries and the campaign trail a little bit. So Tuesday's a big day.
It'd be fun to visit Wyoming and Alaska as well if you were doing it doing that coverage in person.
We're all out there, and I'm like, I'm starting to feel a little like I'm missing out a little bit.
Nostalgia for the campaign trail. Never thought I would hear it from you, Kevin. Thanks so much. Good to see you, Kevin Cirilli, Yahoo Finance contributor. All right, let's take a look at two trending tickers now. Shares of Disney are moving higher. Shares of Amazon moving a little lower. Let's talk about Disney first. Dan Loeb's third point, taking a new stake, I should say a renewed stake. And that is according to a letter that was put out by Loeb here. Remember, Loeb, in his third point, had a stake in Disney, then exited that stake in March. And now he's saying they've taken a significant stake. We don't know how much it is. It's likely below 5%, because if it was above 5%, that would trigger a filing. But they are now filing to become an activist investor and are pushing for some changes. And it's funny because Loeb kind of says, you guys might already be working on this stuff, but it might be non-public material information, cost cutting. He wants them to still not pay their dividend. So some changes that he's pushing for here.
I'm still trying to figure out if Dan Loeb has the same juice as he did. I think we're past peak Dan Loeb and where he was 10 years ago. The real activist investor firm on the street, that's Elliott. You want to get things done? It's Elliott. Look what they're doing with PayPal. But just going on here through this letter that Loeb put out here, they want them to spin off ESPN. Not a new idea. I think they've been talking or thinking about that internally at Disney for some time. A lot of folks in the street have put that out there. But here you have Dan Loeb pushing that.
Yeah, using some of their kind of dividend policy to pay down debt, repurchase shares, or organically reinvest in the business. I think for Hulu as well, what they mentioned also, and it was kind of congratulatory in some of at least the outset of this letter to say, yeah, we recognize that you are on this path that you've set forth, and it's been a difficult transition, seemingly so. But at the same time, yeah, the spinoff of ESPN, other cost-cutting measures. They are talking about Hulu as well and the unreasonable price expectation at the time, and we know this is a priority for you and hope there is a deal to be had before Comcast is contractually obligated to do so in about 18 months in terms of the minority stake that Comcast still has in Hulu as well.
Dan Loeb, great quarter, Disney. Here's a bunch of ideas that are not new. We just wanted to write a letter.
Yeah. And be heard.
And be heard.
Yeah.
We had to.
I mean,
it is what it is.
I don't know. But, okay. Well, we'll see what happens with that. But anyway, the reason we were looking at Amazon as well is that Seth Klarman of Baupost is taking a stake in that company, according to CNBC. So it's not giving the shares a boost. They're actually moving lower here this morning. But nonetheless, it's interesting that we're finding about these well-known sort of hedge fund guys who are investing in these big companies.
And he's seen as a value investor. So interesting to see him take some position. Amazon, also Warner Brothers too, I believe as well, coming off of their very challenging quarter.
Yeah, absolutely. Amazon and all of both of these kind of intertwined too. Of course, Amazon has so many other businesses outside of what Disney has, but for both of them right now in the media business, where it's going to get even more testy, competitive, and going after sports rights, acceleratingly so as well in the near term, that's where we could see some of that overlap in the types of contracts that they're looking to go after.
Yeah. Well, coming up next, what the Inflation Reduction Act means for clean energy. We're going to talk to the CEO of Plug Power on the other side of the break. Shares of Plug Power are up a bit today, but they did surge quite a bit last week on the back of the company's earnings report. Despite seeing revenue miss expectations, the company got a boost from upbeat analyst calls following the passing of the Inflation Reduction Act. Joining us now to discuss is Plug Power CEO Andy Marsh. Andy, thanks for being here. So just give us in a nutshell what this new law is going to mean for you.
Well, Joy, Plug was on a great track before the new law, where we were a target for our $3 billion 2025. But what it does is make the green hydrogen plants, which we're building across the United States, economically competitive with gray hydrogen across all sorts of applications, from fertilizing manufacturer to green steel to green hydrogen for use in peaker plants. It actually just changes the dynamics completely with a $3 tax credit for green hydrogen. Good for Plug, good for the nation, good for the world.
Okay, Andy, so how good? When should investors start to see the impact of this flow through to your bottom line?
As we said on the earnings call, our CFO says it pushes our path to profitability up 6 months into early 2024.
What are customers asking differently from you right now? Walmart is one of your biggest partners as well. And so with regard to the relationships that you have with those customers, where they're leaning further into that relationship, what are you hearing on the demand side?
Well, I think what we're hearing on the demand side, and you could see it, another portion of our business is our electrolyzer business. We're already 50% ahead of what we expect to book for the whole year on August 1. So what we're seeing is tremendous demand for our electrolyzers, which will be used for both here in the United States and in Europe. We're seeing increased demand for our green hydrogen, for the 70 tons of green hydrogen per day that we'll be producing by the end of this year. All that's beneficial to Plug. And we're doing it, quite honestly, because customers like Walmart, Amazon, New Fortress Energy, all want us to be producing green hydrogen or building electrolyzers for them so that they could use green hydrogen.
Andy, for potential clients, is the biggest thing holding them back the cost? And is that one of the reasons why this bill could be particularly helpful?
I think cost, it takes it off the table. Now green hydrogen is cost competitive with gray hydrogen. Now green hydrogen can be easily added to natural gas. Yes, I think it is a big driver, which drives a lot of the industrial applications. And in the industrial applications represent 26% of the world's CO2 emissions, which is equal to mobility. It really takes it off the table. We don't have to discuss it anymore. And now we have security. This bill provides a 10-year tax credit for green hydrogen, as well as a healthy tax credit for fuel cells through 2025, which turns to tech neutral after that. So, Plug, and I think the industry, it provides insurance that it'll be around for the long run. So that's why I think folks in both, industrial applications as well as retail applications, as well as mobility applications, are all excited about this bill and really has changed the landscape for our company and others.
Andy, you mentioned you won't be profitable until 2024. So over the next 15 months or so, where are you going to be investing the most? What areas?
Oh, it certainly is in our electrolyzer and green hydrogen plants. I mean, we've announced we're going to be investing $1 billion for our green hydrogen plants next year. We're obviously, we've had 2 new factories, one coming online as we speak in Rochester, a gigafactory for making, stacks for green hydrogen plants as well as for our electrolyzers. That's where we're putting the dollars today.
You've called data centers a $40 billion opportunity for Plug Power. Where do you start to realize some of those opportunities actually come to fruition, and how quickly does that become accretive to that path to profitability for the business as well?
Well, we've announced that we'll be deploying 60 megawatts of products for the stationary market, which is more than just data centers. Over the coming year, we expect that to be 200 megawatts over the next 18 months. It'll be used not only for backup power, but also for providing power to electric vans, which may seem odd, but it's a big market opportunity. In the long run, fuel cells in these stationary products replace peaker plants. Very much what we're doing with SK, where we'll be deploying 200 megawatts by late 2024 and 400 megawatts per year from 2025 to 2040 with our great partner SK in South Korea.
Plug Power CEO Andy Marsh, always great to chat with you. Good luck on the path ahead. We'll talk to you soon.
All right, always a pleasure. Thanks, guys.
Thanks so
Bye
much.
now.
Have a great week. All right, coming up, Cisco shares in focus after one analyst came out here and hammered the company rating-wise ahead of their earnings. We'll have more on that next. Welcome back. For our first call of the day, we are locked in on a sell rating being slapped on Cisco ahead of the company's Wednesday earnings release. That call comes from Citi's Jim Suva, who is concerned about supply chain challenges and market share losses. Suva is the only analyst on Wall Street with a sell rating on Cisco. I applaud his dedication to his craft and his willingness to stick his neck out there. But look, all signs point to potentially weakish quarter when Cisco reports later in the week. We've seen, of course, we talked about earlier in the show, weakness out of China, a key market for Cisco. We've seen challenging economic conditions here in the U.S. And in Europe. So I understand his call from Jim, certainly into earnings.
And they're reporting what, on Wednesday you
yes.
said, yes.
Yeah, and you talk about pull forward in demand. I mean, Cisco, WebEx, any telecommunications company that has seen so much of the partnerships or the major deal making for their sales units actually come forward because of the pandemic and the number of people that were using some of those solutions for collaborative purposes. And now you see, as people are coming back to the offices, that's still relied on, but how much are they actually upselling into that client base? And for cost management that many of those partnerships or those clients may be going through, does that mean that they're going to pull back for an extended period of time on the additional purchases, or whether that be licenses or products that they use from a Cisco?
Yeah, those shares, by the way, are down about 27% year to date. Like most everything, they've bounced from the lows, right? They're up only about 11% from the lows. So a little bit of optimism from the market going into the earnings.
Big week of earnings.
Yes.
Big week. Also, let's take a look at another call. Checking in on Dollar General here. BMO Capital Markets downgrading the store chain to market perform as the firm believes that Dollar General's valuation is close to peak levels on recessionary comps. The title of this letter was Breaking Up is Hard to Do, and unfortunately priced for perfection is what they added on to here. So the new target that they had put out there, $265 it looks like, and particularly here from Kelly Bania saying that they're downgrading the company because they think that the valuation is close to some of these peak levels on the recessionary comps, as we mentioned. But it's still a strong play right now if you're looking at Dollar General or Dollar Tree, depending upon where some of not just the earnings results for this most recent quarter come in. I believe Dollar Tree is reporting next week, and we'll get even more data out of the mind of the consumer from these reports that come forward in retail this week to really see exactly where they're spending most of their dollars, if you will. And so for Dollar Tree, Dollar General, I think that's exactly where you've got to keep an eye on, is how they're also moving through inventory, even if at a lower price level.
Yeah, and this note brings up a good point. So they're calling out, probably see a good consumer strength, sales strength at Dollar General, but they're concerned about Dollar General being sucked into this discounting that's going on in retail. And if Dollar General has a discount from $1 to 25 cents, that's not good for margins.
Well, Dollar General isn't just dollars.
It's not just, okay, $1.50.
And Dollar Tree started charging above $1.
Yeah, they're above $1.
Yep.
Yes. After an activist pressure.
Dollar General, dollar on the name of Dollar General is more figurative than literal,
that is correct.
I believe,
that is
at
correct.
this point.
You're on the mark.
So that's
should be Value General.
Yeah, so we should watch, but we should definitely watch the margins at that company. All right, and let's talk about online used car platforms, because Vroom and Shift are being hit with a downgrade from JP Morgan as the analyst there continues to see a challenging backdrop for the used car industry broadly. Analyst Rajat Gupta downgrading both companies to underweight from neutral. And by the way, both these stocks, it's not like they're up. Both these stocks are down sharply for the year to date. I think in the case of Vroom, it's about 80%, and Shift is down more than 60% this year thus far. So, it hit a man while he's down, I suppose. And so the analysts here are saying that there might be better opportunities within the used car business as things start to improve. He says, we prefer companies that have ample liquidity and or diversity in their business to navigate an uncertain macro backdrop. So effectively, he's saying that these are some of the weakest positioned players in this industry.
Yeah, clearly JPM just downshifting into first gear on both of these names. But yes, that's a takeaway from reading this note, Julie. I don't think the analyst team at JP Morgan just doesn't trust the fact that these companies can make it through without another capital raise. And you look at Vroom, I remember that stock came to market under much fanfare. Both of these stocks, they're essentially penny stocks now.
Well, the question among the consumers, too, is if I'm going to buy a used car and it's already going to see a much higher price year over year and year over two than I would have been accustomed to, and perhaps I'm not even getting the same type of warranty, type of guarantee from that dealership as I could get on a new car, as long as you could find the new car and it's on the lot, then that is just a cost comparison that any consumer would naturally go through, and that's going to directly hit a Carvana, a Vroom, car lots. And so, as all of them are navigating where they've got inventory as well, and the amount of backlog that they're also able to not just get off the lot, but then have more customers continue to come back and make purchases at higher levels on perhaps a lower demand at those levels, I think that continues to just be that near-term headwind that they haven't been able to solve for.
Yeah. In the meantime, JP Morgan says it likes bricks and mortar car dealers because they have stronger free cash flow.
Like Joey down the block. They like that independent owner. There we go. AutoNation, I guess. AutoNation.
They got some good deals down the blocks.
Yeah, down the block.
Shifting gears now.
Literally, shifting
do.
gears.
Yes.
Shifting gears.
To food spending. Your favorite fast food chicken sandwich slightly costs more today than it did 6 months ago. Are we still in the chicken sandwich wars? All right, on pricing, maybe.
Yes.
Despite
apparently.
inflation cooling down in July, food prices continue to skyrocket. According to the Bureau of Labor Statistics, known in your hood as the BLS, July Consumer Price Index, CPI, the cost of food rose 10.9%, highest increase since May of '79. Yahoo Finance's Alexandra Canal joins us now to break down the impact. Okay, chicken sandwich wars here. Let's talk it a little bit, Allie. What's going on here?
I mean, Brad, take my cheap gas, but not my cheap chicken sandwiches. I think that's the moral of the story here. But according to exclusive data that Yahoo Finance, I'm sorry, I'm so verklempt by the chicken sandwiches. But from that Yahoo Finance received from Edison Mail, formerly Edison Trends, you'll see the average price of chicken sandwiches has steadily risen over time, 18% higher on a year-over-year basis. Now, this is based on data from over 240,000 online direct orders from 10 quick service restaurants. And if we dig into that data a little more specifically, you'll see on your screen here that these are individual sandwiches. Now, for example, if we look at the price of both Popeye's spicy chicken sandwich and McDonald's spicy crispy chicken sandwich since January, that has risen 13%. But on a year-over-year basis, Popeye saw a whopping 22% increase for that sandwich. So folks were paying $3.92 in July of 2021. July 2022, they're now paying $4.80. And if you want to take that even further in context, we could look 2 years ago between July 2020 and July 2021. The cost of a Popeye's spicy chicken sandwich, that cost actually decreased by 6%. So down 6% July 2020 to July 2021, now up 22% July 2021 to July 2022. So inflation definitely real here.
I want to like that new Panera chicken sandwich, Allie. I'm just not there emotionally quite yet. All right, Alexander Canal, thanks so much. Coming up, we'll go down to the floor of the New York Stock Exchange to chat with Getty Images CEO Craig Peters. The company just reported its first earnings report since going public in late July, and the stock has been doing pretty darn well. Don't go anywhere. Locked in on shares of Getty Images today after the company reported its first earnings after going public in late July. The stock is up considerably since closing its SPAC merger on July 25th. Joining us now from the floor of the New York Stock Exchange is Getty Images CEO Craig Peters. Craig, good to see you again. Look, the stock has come out of the gate pretty strong since the debut. What do you attribute that to?
You know, I really can't give you an answer to that. I think, you know, we're focused in on building a business. And it's a business that's been around for 27 years. I think we've got a great brand. I think we have a really solid product that helps, you know, millions of customers, you know, basically get their job done in a more efficient, higher quality manner. And so, you know, I think that's ultimately what underpins this business. And ultimately, I think the stock is a reflection of this business. And that's what we're focused in on going forward. It's just building a great company based off great content and really servicing our customers' needs.
Investors in any company want to hear a good growth story. What is that growth story for Getty, and where do you envision unlocking some of that trajectory?
Yeah, you know, so growth from us is, again, it starts with great content and making sure that we're bringing the very best content to our customers. But there's more and more customers that need our content every day. Most notably, the corporate market is bringing a lot of their presence, their digital presence in-house. And so they need more and more visual content to feed their websites, to feed their social media. They need to do that on a more frequent basis. Increasingly, video is kind of the next leg of growth. It's been a core growth driver for us. You know, we're a business that's in, you know, about selling into about 200 countries, but we still, you know, have more than half of our revenue sitting outside of North America, but there's still a lot of geographic opportunity for us to grow. And we're focused in on that. And then, you know, we made an acquisition about 5 quarters ago in a company called Unsplash, and they really reach out into the long tail contributor and creator economy. And so we're excited about that acquisition and what it can bring to Getty Images. And then, you know, there's Web 3.0 is taking shape, and I think we're watching how, you know, our content and our capabilities have relevance there. But it all starts with great content and really, you know, customers needing more and more of it every day.
Hey, Craig, it's Julie here. I know you've been with the company since 2007. You've been leading it as CEO since 2019, if I'm not mistaken. How are you? And this is an interesting trajectory for Getty because it was a public company, then was a private company, now is a public company again. So how are you thinking about that journey now? And as a public company, what that will afford you? And what kind of resources you're going to be able to tap into as you look to that growth?
Yeah, well, I think, you know, one of the constants of this business throughout is it's an incredibly profitable company. And that's what allowed us to go private and take on certain levels of leverage. But, you know, what this transaction, going back to the public markets, is about is taking about $1 billion of fixed commitments off of our balance sheet through preferred stock and debt. And that gives us a lot of flexibility and a lot of firepower to really go after the market opportunity that we see in front of us. And we're excited about that market opportunity as I was talking through all those growth vectors, whether that's video or international or just kind of reaching more and more customers. So we're excited for what this transaction means to our balance sheet and fundamentally what it means to our ability to pursue those growth trajectory. And we're excited for our employees. You know, this is one where our employees, again, we can kind of give them equity in this business and allow them to really participate on a broad basis in the success of this business.
All right. Well, it looked like a picture-perfect video up there on the podium at the New York Stock Exchange earlier today, ringing the opening bell. Thanks for joining us here this morning on Yahoo Finance. Getty Images CEO Craig Peters. We'll check back in later on. Everyone, coming up on the other side of this short break, clip in Peloton hiking prices and scaling back on its retail locations as it looks to cut costs. We've got the deets for you coming up next. Welcome back, everyone. It is time for Cut for Time. 2 stories, 1 minute each. Today, we start with this. WeWork founder Adam Neumann has a new venture and a surprising new backer. Neumann reportedly starting a new company called Flow, which is focused on the residential real estate market and has the financial support of Andreessen Horowitz. Of course, an early investor in companies from Facebook to Airbnb. Okay, let's chat about this here. More funding for Adam Neumann after WeWork is now valued at...
I'm kicking this one to Julie.
WeWork is now valued about $4 billion. $47 billion was the peak valuation of WeWork. He walked away with hundreds of millions of dollars. This new company, Flow, and this is all according to the New York Times, by the way, this new company, through Neumann, he's basically bought 3,000 residential apartment units. I believe it's multifamily, it's apartments. And it's going to be, I mean, this is effectively a new version of what he had envisioned as part of the WeCo, right?
Yes.
That this is going to be all branded the same as Flow. And
Are we supposed to flow into these places? I mean, this is just, it's ridiculous.
I mean, it's amazing that after the story that and this is the largest single investment that Andreessen Horowitz has ever done in this round.
We wish them well. All right, the future is looking gloomy for Peloton after the company announced a $500 price hike to its bike and $800 jump in its tread price after it had to cut prices back in April. The company also announced close to 800 job cuts. And guys, we saw Peloton shares. This broke late on Friday. Peloton shares popped on Friday, close to 20%, giving back some of those gains today. And, I obtained a letter from CEO Barry McCarthy, who took over, I believe it's late in February, noting this. He said, quote, "Cash is oxygen. Oxygen is life. We must become self-sustaining on a cash flow basis."
That makes sense.
It makes a lot of sense. And look, Barry was brought in with a very specific mission to cut costs, get profitability correct. And he won't say this, but this is where this is going. At some point, Peloton will be sold within 3 years. That's what he is setting the stage to do, because I see these cuts as a clear sign demand has not come back. We've talked to Jim Chains last week, Planet Fitness, Exponential, good results. Here you have Peloton cutting jobs. So, the at-home fitness market, that bubble has popped and Peloton's struggling.
Well, sales are also your water as well in that life expectancy and moving forward. Well, got buzzed, but anyway.
I like all these analogies, guys. All right, we got to leave it there. Let's take one final look at the markets here as we see selling across the board here, although it's not quite as acute as we saw earlier in the session and what was indicated in the futures, with the S&P only off about 1/3% right now. Coming up in the next hour, Brian Chung and Akiko Fujita are going to speak to the U.S. CEO of eToro about the state of the retail trader. Obviously, it has been very interesting, fertile ground over the past few weeks in that space. You don't want to miss that.
Welcome to Yahoo Finance Live. I'm Akiko Fujita.
And I'm Brian Chung. Happy Monday morning to everyone. Let's take a look at where we are in the trading session. 90 minutes in, we can see red across the board with the Dow Jones down about 0.2%, the S&P 500 down 0.3%, and the Nasdaq down the same as well. If we take a look at the fixed income market, some movement happening in bond yields as well. When you take a look at the U.S. 10-year down, get this, about 7 basis points just this morning, extending those slides from earlier in June to 2.78%. Of course, a lot of other news headlines weighing on markets right now, but across the board, pretty much red across the board.
Yeah, one of the key things we're watching this morning, oil sliding as the energy space feels the weight of the weak economic data coming out of China. This raising concerns that a slowing global economy will reduce demand further for energy products. Specifically, we got economic data out of China this morning that points to this broad-based slowdown. We're talking about data on factory output, investment, consumer spending, real estate. All of that, of course, led the central bank, the PBOC, to cut two key interest rates at a time when we've seen, other major central banks going up. I guess you could argue that this is all, maybe not all, but a lot of this stems from the zero COVID policy. And it is these stop and go policies that just haven't allowed China to get the momentum going towards recovery.
Yeah, certainly. And obviously the economic activity, which covered the first quarter of this year, which China has substantially reopened since that point in time, pointed to just how damaging that was to the world's second largest economy. But at the same time, a lot of the factors that we're looking at in China are still kind of secular trends that were happening before the pandemic as well. When you talk about the government's essentially efforts to deleverage this very, very highly indebted economy, especially in the property sector, right? And the weakness in that area is one big reason why you have a lot of people concerned about the Chinese market. Bank lending is down as part of all of this, and then now that the PBOC is cutting interest rates, you do wonder about whether or not there is this concern that China is also going to get into some sort of hard landing or hard recession, which could have massive spillover effects globally.
Well, and it is to spur lending, obviously, when we're seeing what's happening over in China. You mentioned some other stats here, but it's worth noting youth unemployment, and that's something that we've talked about before in 20%. China. 20% in July. That is the highest number that we have seen since they began publishing that data. Granted, that's back in 2018, but certainly a lot of factors that are lining up for all of this. Obviously, we've seen some big moves in oil today on the back of it, coming off of the lows that we saw earlier on in the session, but still down more than 3%. Now, I will throw in one other thing that we're going to be watching throughout the day here, and that is any kind of decision on the Iran nuclear deal. Today is the deadline that the EU set for Tehran to essentially come to the table on this framework that they have created. Specifically, there's a key sticking point here worth noting right now. It's the IAEA's investigation into this material that was found in Iran back in 2019. Iran has said this is not a sign that they have a nuclear weapons program going. The West has disagreed. They have said, they as in Tehran, have said that the condition to moving forward to revive this deal would be for that IAEA investigation to end. So the foreign minister's come out and said he will make a decision by midnight tonight. So we've got a few more hours to go, but that could be something to be watching in the context of the oil markets, too.
Right, yeah. So we'll see if maybe there are developments over the next few hours, but a lot of eyes, I'm sure, on any announcements that can come on that front. But shifting gears as well, a lot of other economic data crossing this morning domestically, where we saw, at least from the New York Fed, manufacturing activity seeing a sharp decline. The New York Fed reporting this morning down 42% on their Empire State Manufacturing Survey. You can see the line ahead of you. That's down to the lowest level since the pandemic time, and this shows just how pessimistic manufacturers, at least in the northeastern part of the country, are feeling. And combine this also with the information that we got from the National Association of Home Builders, the NAHB, where they said that they saw builder confidence fall for the 8th straight month. Quote, tighter monetary policy from the Fed and persistently elevated construction costs have brought on a housing recession. So if you kind of combine these two threads together, Akiko, what that really kind of shows is an American economy that does indeed have signs of slowing down, which the Fed might want to see because hopefully that cools inflation. But of course, the natural question is, has this started the momentum into a hard landing here with economic activity possibly falling off a cliff at the same time rates are still going up?
And of course, we've been watching the housing market really closely as potentially kind of the leading indicator of where things are going in the economy. Let's fold all of this into one big conversation with our first guest for the hour. We've got Steve Sosnick, Interactive Brokers Chief Strategist. Steve, let's kick things off. It's on a Monday, right, with where the markets are. I mean, we're coming off of 4 straight weeks of gains. Obviously, China's data today coming out weighing on investors as we see red arrows across the board. Where do you think we are in the cycle?
Good morning, Akiko. I think we're sort of in a part of the cycle where we have to be very careful about the hard landing. You know, you guys just spent the last few minutes going over a series of indicators or a series of related stories that don't paint a good picture for the economy, and certainly will not be helped if the Fed continues to be on a path about fighting inflation, which I'm not suggesting that they don't need to be on that path, but it becomes inevitable. One of the problems specifically with China that, today I think it's being taken almost as a positive by the markets because, if Chinese demand is slowing down so dramatically, well, of course, that's going to impact commodity prices negatively. There's a lot of people who have, algorithms, whichever, programmed to say, okay, oil down, stocks up. So as a result, we're really not seeing any real give back. We've given back the levels more or less of the last few minutes of Friday trading, which in itself was a bit of a ramp. So, I think we're in a fairly precarious time for the markets, and a lot of investors sort of seem to be covering their ears and just doing what they've been doing before.
So, Steve, that implies, though, that despite all of that, you still see a lot of retail activity. I guess I'm wondering on your platforms, despite Fed concerns, despite uncertainty out of China, despite a perhaps head fake on this bear market rally, people are still diving into stocks. Is that what you're seeing?
Absolutely. We are seeing it's not the meme stocks are, I guess, are the perfect tell for this. And to a certain extent, crypto coming back, testing 25,000 is another tell. The retail is back. We one of the most actively traded stocks on our platform, was MEGL, which went from like 7 to 250 and back down to single digits within the course of about a week. You have the HKD looniness, going from an IPO to over 2,500 and then large, giving back about 90% of it. So yes, what I'm seeing overall, and I keep finding the fact that I'm using this phrase over and over again, a lot of people are using the playbook, the 2020, 2021 playbook over again. It was a spectacular playbook for that period of time, but the rules of the game seem to be changing, and people, for now, the playbook is working, but people seem to be using the same playbook and expecting the same results. In the short term, I think it's been fabulous. I think it was a great bounce off an oversold condition, but I have to wonder if using the same investment playbook that worked for you, which includes don't fight the Fed, which in that period of time was, the Fed was your friend. Now the Fed is kind of a headwind. This is the problem I start to see.
I mean, what is the key difference? If you've got retail investors out there who are saying, well, why not go with the same playbook, given the gains that we saw on the back of the big declines we saw early on in the pandemic? And what's the key difference in, should they be buying the dip?
Well, buying the dip is a great strategy. On the other hand, we're up well off. We're not at a dip anymore. We're well off our lows. Looking at the backdrop, I'm not going to criticize investors for having bought the dip. It was the right strategy at the right time. We were very oversold. We went into earnings with the most dire expectations, and earnings were better than feared, certainly, and that provided a lift. And I think the last part of this rally has been the investors sort of taking Powell's neutral comment to heart. Meanwhile, all the other Fed governors who've spoken since have basically been squashing down on that idea. But now you're in a momentum phase. And so investing just because of momentum, that becomes a bit trickier than trying to time the dip. The meme strategy worked great for whoever, the meme stock trading works great if you're early. It works terrible if you're late. We've seen that time and again. Those seem to have a shorter and shorter half-life in terms of success rates. And in terms of other stuff, there are plenty of good stocks to be buying out there. I don't want to really squash down on this, but just sort of, when I saw Friday, the strategy of sort of, instead of don't short adult tape, it became let's buy at money expiring SPY calls. And then as it moved up a little bit, let's roll them up to the next strike, and then the next strike and the next strike. That was just pure momentum on nothing. And so that becomes a much more tricky environment to try to base your trading from the long side on.
So, Steve, I mean, you talk about HKD, you talk about a number of other names that were popping lately. I mean, a lot of people perhaps trying to draw comparisons to what happened in the beginning of 2021 with GameStop to some of the activity that we've seen over the last 2 weeks. Are you seeing any sort of similarities? And is there a reason for a macro backdrop contributing to that, or is it completely unrelated?
I think the macro backdrop was much more prevalent in early 2020. Early 2021, because you had massive Fed liquidity injections and stimulus checks. People, a lot of investors literally got money deposited into their accounts. Now I think it's sort of more of just, we can get things moving in a short period of time. That aspect of it hasn't changed. That's why I alluded to the idea of people using the same playbook. But each of these moves, HKD of course being the exception, but for the most part, GameStop, Bed Bath & Beyond, et cetera, my theory then and now is there was always a certain amount of investor nostalgia to them. People just didn't want to see their old favorite mall stores getting picked on, and so they went after the shorts. Also to be said, shorts, people have been going after the shorts for as long as there have been shorts. So that's also not a change in strategy. The popularity of it certainly is greater. But in each of these situations, there's less organic nature to it. In the initial meme stock craze, you got people coming in who'd never invested before, putting money into these stocks and investing. Now it seems to be the same cast of characters chasing the same list of names with a couple of new exceptions every so often. That becomes more of a self-contained loop, and it really becomes much more about, it's always been about timing, but now it's really strictly about being early.
Steve, really quickly, moving away from meme stocks, what do you like right now? Where are you putting your money?
Right now, quite frankly, as a volatility person, I'm starting to look more in terms of volatility plays and getting a bit defensive. The VIX flirting with 20 means that there are more opportunities to be hedging some of your gains. I actually start to think about looking for pullbacks, being a contrarian. I think starting to look at energy is probably not a bad place to go unless we really feel that the wheels are going to come off in China, because it is going to be winter at some point in Europe, and I see another round of stress coming. But those would be the two biggest places of focus for me.
Okay, as always, some good takeaways there. Steve Sosnick, Interactive Brokers Chief Strategist. Appreciate your time today. Well, let's take a look at shares of Poshmark. Seeing a big rally in this session here, up about 12.5% on an upgrade from Barclays analysts, upgrading the stock from equal weight to overweight. They also raised its price target to $17 a share, citing secular tailwinds in the secondhand clothing market. Barclays saying that consumers are likely to trade down in a softer macro environment, adding that social and gamification aspects of the platform specifically give Poshmark an added lift in engagement. This comes, of course, as Poshmark posted a wider than expected loss in its most recent quarter. Well, coming up, is crypto the new gateway for amateur stock traders? Our next guest breaks that down and why the bear market may have instilled caution in a new generation of retail investors. We'll be right back.
World of crypto on this Monday morning and see if there's any interesting price action. You could see Bitcoin down about 1.6%, but actually watch what happened overnight. We actually saw Bitcoin break the 25,000 level for the first time since mid-June, which shows that there has actually been a pretty nice bounce back in Bitcoin, commensurate with what we've seen in the stock market, although, of course, on a year-to-date basis, still very, very far from that above 45,000 level we had earlier in the spring. If we take a look at some other cryptocurrencies as well on the move, Ethereum down 4% to 1,900, and also watching Doge, why not, down 4.2% to about 7 cents a Kiko.
Okay, well, with the markets experiencing a tremendous amount of volatility of late, investors on trading app eToro aren't shying away. According to a Q2 retail investor survey from July, 92% of investors either held on to investments or bought the recent dips. But how's that continued to hold up over the past few weeks? For more on this, let's welcome in Lule Demise, eToro US CEO. Good to have you on today. Let's start with that question. Brian was talking about crypto specifically, but broadly speaking, what kind of inflows have you seen on your platform in recent weeks?
Yeah, I mean, broadly speaking, for us, what we see is consumers who are cautious but optimistic in the way that they behave. So most of our customers are customers that have told us and have through their behavior that they are more buy and hold, and they are holding through the dips here. There's definitely a split in between our customers when it comes to, about half think that the markets are going to return soon and half think that this is going to be choppy for some time. So the cautiousness is still there. But what's really interesting, I think, from what we've seen on our platform at eToro USA versus, let's say, when I've been in this industry for many years, and what we saw in 2008 is that people are more cautious, but it doesn't look like they're panicking.
Lule, it's Brian Chung here. Great to have you on the program. So, is there any sort of change, though, in the allocation? Because we have noticed over the last, let's call it 2 months or so, a pretty remarkable bounce back across a number of different asset classes. Do you find that people are going into, for example, meme stocks or crypto being more risk tolerant than they were, say, at the beginning of the summer?
Yeah, it's interesting. Our platform is in some ways an anomaly because we attract tomorrow's investors today. So over 55% of our customer base is older millennial-ish, right? And the majority of our customer base is actually Xers and millennials. So we actually see a different spectrum, if you will, of the investor base than most other places. And so for that reason, because these people have a longer arc in their investment life cycle, they can afford to remain sort of long-term and less panicked about the short term. So we do see still people who are less averse to risk. Again, not necessarily new purchases, but what they're holding. And in addition, we're seeing in some instances, especially among our Xer consumers, a little bit more flight to quality to be able to endure this choppy market. But again, not a flight to quality that's wholesale, but at the margin.
Yeah, I mean, how do you think that has shifted from where we were, let's say, at the beginning of 2021? We've talked so much about the growth of the retail investor, but also the evolution. In January of 2021, it was about the meme stocks, and we're hearing increasingly that they're getting into ETFs. They're getting, to your point, into more value plays. How has that broad portfolio shifted as you see it?
So a few places. So one is, you see, as I said, a little bit more at the margin flight to quality, not a panicked one, but just a smart one, right? Because you're seeing more flight to quality right now. We do see consumption in more, if you will, pickier consumption in terms of either the sectors they're picking or the asset classes they're picking. But again, because we have longer term investors, there's a lot that are also seeing this as a buying opportunity. So we do see uptick in technology and other places in which, even though the market has given up some of those gains in the past few months, individuals seeing that as a buying opportunity because, again, their horizon is longer. When you're looking at our platform, you're saying millennials and Xers, majority millennial. It's a different mindset, if you will. The one thing I will say again is millennials of today were not the millennials of 2008, meaning, again, there is that wisdom of the crowd that I feel is you see it embedded in the behavior of the investor that I feel like was not there in 2008. Caution is definitely here, though. We can't underestimate that people are cautious. I think the underlying thesis here, though, is that it's not panic.
Well, can I ask if that millennial dynamic plays into an interesting stat that I read here, which is that younger investors were actually least likely to hold, but more likely to buy more with prices down. So net, is that actually more willing to take on risk? Because that's a bit surprising to me. I thought that it was the younger people who might be more hodl, let's diamond hands here.
Yeah.
What's going on there?
Yeah, I mean, I think part of it is, the story that feels sizzly and exciting is the meme stock, right? And it makes sense, right? Most things that we read, it's interesting, but actually that's not where most of the consumption behavior is, right? A lot of the consumption behavior is not as undiversified as we think it is. People can still partake in a particular individual security that's high volatility or, again, very depressed right now in this market environment, but still buy a diversified ETF instrument. Like, they're not necessarily divorced from one another in the consumption behavior of many individual investors that are on our platform and in retail at large. And so I think part of it is not to get lost with the flash headline and to make sure we're looking at the behavior of the broader body politic of investors that have come into this market.
Lula Demise, eToro US CEO, it's good to have you on.
Hey everybody, and welcome to Yahoo Finance Live this Monday, August 15th. I'm Dave Briggs here with Shauna Smith. After 4 straight weeks of gains for the S&P, will news out of China slow the market momentum? We'll also learn an awful lot about the state of the retail sector this week, and as a consequence, the impact of inflation on the consumer, what to expect from Walmart, and Target earnings from Michael Lasser of UBS. Plus, attorney and entrepreneur Erica Kohlberg has amassed 15 million followers across social media feeds by reading the fine print so you don't have to. She'll share what airlines, credit card companies, and retailers don't want you to know. But first, here's Shauna with the check of the markets.
Hey there, Dave. Great to see you. All right, let's take a look at where things stand here. We have just about 60 minutes to go until the bell. All 3 of the major averages holding on to gains, clawing back some of the losses that we saw as we started the session. Now, investors are bracing for the retail data that we are going to get, retail earnings reports that we are going to get later this week. Also digesting that weak economic data that we got out of China earlier today. On a sector basis, let's pull things up. Consumer staples among the leaders in today's action. Communication services, consumer discretionary also flipping back into the green. Energy, the worst performing sector of the day. We're seeing this as crude slides. Crude ending off just about 3% today, falling below $90 a barrel, settling there for the first time in just about a week. And we're seeing this impact on some of those travel names, travel stocks getting a boost on the lower fuel prices, airlines among the outperformers in today's action. For more on the markets, let's go to our own Jared Blickery. And Jared, we were just talking about, Dave mentioned at the top of the show, Nasdaq, S&P on quite a winning streak as we look at the gains that we've seen over the last 4 weeks. Some on the street are saying that this rally actually has legs. What do you think?
It has some legs, but these are tenuous legs at best. Let's check out the price action. I think investors will welcome the fact that we are set for a fifth week of gains in the market. Of course, this is very early on in the goings here. S&P 100 up about 0.4%. You can see we started out the day in the red there, but I want to look at a year-to-date chart with some candlesticks here. I've been showing this for a couple months now. Finally, we got that bear market rally lift off, and we can see we are up 18%. That is from this low to these highs. You take a look at the Nasdaq, we are up nearly 25%, having eclipsed these numbers here, these prior highs right there. But I want to go back to the S&P 500. 4,200 was a big level. 4,300 is a big level, closing in on this potential resistance area right here. And we were mentioning those potential headwinds. Well, Goldman Sachs has a number of them, and this comes by the market ear. I just want to go to some of the summaries here. Goldman Sachs estimating $28 billion worth of total systematic demand over the next 1 week, assuming a flat tape. So that's if the market goes nowhere. That's $5.5 billion going to come into the market for technical reasons. Don't need to get into the definition of systematic demand. Also estimating another $5.5 billion. So that's $11 billion total worth of corporate demand. And that has to do with buybacks and some other factors. That's also hitting the tape this week. And then $2.2 billion was what happened last week. Yesterday and last week, excuse me, not yesterday, Friday was a big up day in the session. And then another factor, liquidity is expected to worsen as we head into Jackson Hole. That's that big Fed event at the end of the month. Now, lower liquidity means move to the upside and the downside can be exaggerated. So that's both volatility inducing for the upside as well as the downside. Mutual funds sitting on a large pile of cash, that's on the sideline. Hedge funds are regrossing. That means they're establishing positions for the first time in several weeks, oftentimes since the beginning of the summer. And then finally, retail, you only live once, re-entering, and that is you only live once. Guess what? We've seen GameStop exploding to the upside, and it's no coincidence that we've seen a lot of these consumers' names that have been beaten down. This is over the last month. Consumer discretionary up 18%, industrials up 15%, tech, materials, financials, energy, all of those outperforming along with real estate. So a pretty big, broad basket of stocks out. However, we do have some potential headwinds, guys.
Indeed, and we'll talk about a lot of those sectors later on in the program, Jared. But the Nasdaq up nearly 25% from the June lows, leaving investors wondering, are the lows in and am I missing out, or should I be hedging?
I'll tell you what, Dave, there's a saying in finance. You got to hedge when you can, not when you need it. And let's take a look at what the VIX has been doing lately. If you need protection, now is the time to buy it because it's getting very cheap. So here's the SIBO VIX Volatility Index, aka the Fear Index. Actually, this is the VIX of the VIX. Let's go to the VIX itself. That is now below 20, kind of one of those big psychological numbers. 15 is also a bigger one. If you take a look at what had happened in the belly of last year, we got all the way down to about 15 and trended in that 15 to 20 VIX range for a number of months. We'll have to see if that continues, but the risks are to the upside. And I want to get to the strong dollar. That has really been a theme. Now, today, the dollar is up versus a broad basket of currencies, but notably, it is not up versus the Japanese yen. Now, here's a heat map that contains all of our US dollar-based Forex crosses. And you can see over the last month, the dollar has been outperforming versus the Argentine dollar there, Argentine peso. US dollar has been outperforming the ruble, the Turkish lira, also the Chinese yuan. But what is not outperforming is some of the other haven currencies. Now, here's a very similar chart, a heat map with the Japanese yen as the numerator. And you can see it has strengthened via some of these same vehicles, some of these same currencies, such as the Argentine peso, such as the Chinese yuan, but also importantly versus the Swiss franc, also versus the US dollar. So my point is, when we have haven flows into the yen, that can be the marking of a big, big turnaround in risk reversal. We have a decade of low interest rates building up that yen carry trade where traders would borrow the yen and buy other assets. If that unwinds, If that unwinds, and that's a big one, we could have a storm coming, guys.
All right, a big if. Jared Blickery, good stuff. Thank you, my friend. He talked about a lot of sectors up. Real estate is certainly not one, and we'll get several key glimpses at the state of the slowing housing market this week. And first up, builder sentiment dropping 6 points in August to 49, marking an 8th straight decline in the index, said National Association of Home Builders chief economist Robert Dietz, quote, tighter monetary policy from the Fed and persistently elevated construction costs have brought on a housing recession. Shauna will also see housing starts, existing sales, and of course, earnings from Home Depot and Lowe's. And do you expect any of that to be positive?
I don't know. I think it's going to be a tough couple of quarters here, especially for some of those players like you just mentioned, Home Depot and Lowe's, directly tied to what we're seeing play out in housing. I think it's a little bit worrisome when we're starting to see these numbers that we have been over the last couple of months inside the Home Builders Index. We had Robert Schiller on the show just last month, and he was saying that the number one thing that he likes to look to in order to project a recession or really get an overall sense of the housing market is that buyer traffic number, which is included in the NHHB index. And that number dropped to 32, putting that in perspective, the lowest level that we've seen since April 2014, outside of the first couple of months of the pandemic. So certainly a worrisome sign here for the housing market. We're expecting to see some cooling, but now I think there's a little bit of hesitation here or concern just what this means for the broader economy.
Yeah, there's some fear of a crash. I certainly don't see it when talking to real estate experts and realtors across the country, although certainly a cooling. What you're seeing is, again, mortgage rates are 5.22. Sounds like a terrible number because it's more than twice what we were a year ago, but that's still a relatively low number when you consider perspective over the last 20 or 30 years. But what you're seeing is so many people sit on the sidelines because they're well aware that prices continue to fall. But on the flip side, in all likelihood, that mortgage rate at 5.22 is going to continue to go up. So ultimately, the price they pay for a house is going to continue. So on an interesting tidbit on Google searches, after we found out that negative GDP print for the second quarter surged 2,000% for sell my home fast. Obviously an all-time high in surges for that search. So certainly a lot of signs of a cooling, hopefully not a crash.
Yeah, we will see. Only time will tell about that. But I agree. There certainly are some worrisome signs, although when you take a look and compare it historically speaking, the housing market still looks pretty strong. All right, coming up next, the price of gas falling now at $3.96 a gallon. That's the average nationwide. We are going to tell you what to expect going forward. And Tesla aiming to electrify its stock following a key milestone. More on that when we come back. Welcome back. Check out shares of Warner Brothers Discovery. After several weeks of speculation, layoffs are reportedly hitting HBO and HBO Max. Now, the cuts are coming to the network's reality programming and casting divisions and will affect roughly 70 jobs, according to several published reports. Now, the move comes amid broader cost cutting after the Warner Brothers Discovery deal closed earlier this year. The company will combine Discovery Plus and HBO Max next year. Shares today off just about 3.5%. Let's take a look at the broader market action. All three of the major averages now in the green. The Dow up 148 points. Visa, Disney, Coca-Cola leading the way this afternoon. For more on today's market action, we want to bring in Brian Jacobson, Allspring Global Investments Senior Investment Strategist. Brian, lots to focus on this week. We had the weak data out of China this morning. A number of retailers set to report earnings over the next couple of days. How do you think the market is digesting what we heard from China and what this means here for the U.S.?
Yeah, it was actually kind of a pleasant surprise to see the way that the market digested the Chinese data. You had the industrial production numbers falling short of expectations, retail sales falling short of expectations. And even though the People's Bank of China did cut rates, it was only by about 10 basis points, so 0.1 percentage points. To me, that seems a little bit like a kind of a rather weak response to it. But, the market seems to be in a rally mode right now. And I think a lot of it is because there was quite a bit of damage that was done in the first half of this year. More than a 20% decline in the S&P 500. You had more than a 30% decline in the Nasdaq. So there was a repricing of the market. So already expecting a lot of bad news. And so far, at least with the US data, things are looking a little better than people perhaps were fearing. And I think that can explain the resilience of this market so far, is just that low expectations and a resilient corporate America.
Some, Brian, have suggested that the market is rallying on the thought that the Fed will have to cut rates late next year. In fact, former New York Fed President Bill Dudley said markets are misunderstanding the Fed's inflation response. Are they?
I don't think so. And I have a tremendous amount of respect for Bill Dudley, so don't get me wrong on this. But I do think that the market is pricing in a continuation of the Federal Reserve hiking rates. It's just at a somewhat slower pace. Now, when you do look at market traded instruments, as far as like the Fed funds futures, what is that telling us about what might happen in 2023? Yes, that is pricing in some rate cuts, but we have to take that with a massive grain of salt. The Federal Reserve is effectively flying blind as far as when it comes to what the economic data will be. And so are market participants. I think that really what the market is pricing in is that if we do get a slowing of growth and inflation at least heading in the right direction, if things get too bad when it comes to the growth outlook, that the Fed will eventually cut. However, I don't think that's a foregone conclusion. I think that if we continue to see growth, maybe finding a bottom here, getting a firmer footing going forward, that the Fed can maybe put things on cruise control in 2023 instead of needing to actually cut rates.
Brian, we did get that slightly tamer inflation report, I guess you can call it that, at just around 8.5%. Do you think we're starting to see some light at the end of the tunnel?
Yeah, so here at Allspring, my Systematic Edge multi-asset team, we've been talking about that. And it's kind of weird that we would be cheering at an 8.5% year-on-year inflation number, right? It's tame, but only relative to the 9.1% that we saw for the month before. But the important thing is that it's heading in the right direction. We released a blog saying that we think that actually the inflation outlook is about as clear as mud. And I think that's a good description of what the outlook really is. Yes, we have this incremental improvement, but we need to see another month's worth. When you peel back the layers of inflation, there are signs that the services from, like, say, owner's equivalent rent, other services, that part is firm and increasing, but the durable goods, non-durable goods, so non-durable goods would be like food and fuel, whereas durable goods would be like appliances and autos. So those goods parts might actually tip into deflation, but the services, that's more the persistent trend. And that's where it's still a long road that we have to walk here to get inflation back to 2%. But maybe we've taken at least the first step in that direction.
All right, let's hope so. Brian Jacobson, good to see you, sir. Thank you. Coming up, how low can it go? Oil prices have been tumbling due to slowing demand. We'll discuss the energy outlook when we return. All right, oil prices have fallen to their lowest levels in months. Crude prices hit their lowest point since January. Now at below 90 bucks, 89.26. Brent at 94.94, lowest since March. Where are we headed? Stephen Shorrock is the co-founder and principal of the Short Group, joining us now. Good to see you, sir. How low can we go, and what is driving oil prices so low?
Right now, what's driving oil prices today is the news twofold. First, the disappointing numbers coming out of China, that China had a severe economic contraction in latest read, and also progress being made on the Iranian nuclear talks. So we're at a situation right now where the global economy is on tenterhooks. Are we not in a recession? I do think we are currently in a recession, and hence why we've seen a tremendous pullback in gasoline demand here in the United States, to the point where gasoline demand is about 200,000 barrels a day below normal. That is to say, adjusting for seasonality, we are 200,000 barrels below where we normally are. So significant pullback demand signals out of China that that contagion might be spreading, and also with the possibility of Iranian oil coming to the market. And it is now the middle of August, so we only have about 4 more weeks, and then we transition out of the peak demand season for gasoline. And as we go into the shoulder months, September and October, demand will continue to fall off. So we have a confluence of events. Some of them are good. That is to say, the season is coming to an end, so demand will fall. But some of it is bad. Part of that demand destruction is because of consumers are taking a prolonged hit to their wallets.
So, Stephen, what do you think this means for gas prices? We just had it up on the screen. It's $3.96 today. That's the national average. You're talking about demand falling even further from where we are today once we get out of this peak summer demand season. Are we talking $3.50, below $3? Give us a better sense of what we could likely be seeing at the pump.
Sure. Certainly $3.50 is well within hailing distance. If for no other reason, if the market just was in a vacuum right now, beginning on September 15th, we begin to transition from summer-grade gasoline, which is very expensive to manufacture, to winter-grade gasoline, which is cheaper to manufacture. So historically, when we get into that early September, late September area, we see a 20-cent decline in gasoline prices simply because we're putting a different type of gasoline into our cars. So clearly, we're looking at least another 20 cents. So that would get the national average down to $3.70. And then when we look at the current correction that we're seeing in crude oil prices, for every $1 move in crude oil prices, you see about a 2.5 cent move for retail gasoline at the pump. So given that we've come off another $10 from the recent means, we're looking at potentially another 20 cents. So yes, I think $3.50 is eminently doable from now until the start of the fall.
Great news for the consumer. We stopped tapping the Strategic Petroleum Reserve in October. What impact will that have?
It's a good question because right now the SPR now is down at levels since the last time my hometown Villanova Wildcats beat the Georgetown Patrick Ewing Georgetown Hoyas in April 1985. So with all those barrels, look, I don't think it really made much of a difference. We're still considerably higher. That is to say, oil prices today than when we started draining the reserve a year ago. The issue is, and always has been, always shall be, is the lack of refinery capacity. Remember, we don't put crude oil into our cars, we put gasoline, and we do not have enough infrastructure to turn crude oil from what it is to what we need. So as long as we have that chasm, there's always going to be a long-term structural deficit between supply and demand. So at this point, it's a refinery issue. The demand destruction is answering the lack of supply in the market. I do want to point out we are seeing a significant pullback in futures, i.e. the paper market, the physical market, the actual price of wholesale gasoline in New York Harbor, major disconnect. The physical price of gasoline in New York Harbor is much higher than what the futures are suggesting. That is to say, because we're looking at gasoline inventories in New York Harbor at more than 10-year lows. Why am I referencing New York Harbor? That's just because this is the delivery point of the NYMEX gasoline contract. So we're looking at very low supplies, very high physical prices. Something has to give. Either the physical price of gasoline contracts to meet the price of futures, or conversely, futures rise to meet the price of the physical. And I'm going to go futures rise to meet the price of physical, because that's where the real market is.
So, Stephen, we have SPR winding down. We also have the EU embargo on Russian oil coming into effect in December. If that, in fact, does happen, what happens then with the energy market?
At this point, we're just going to continue to look. And this is why I think we are in a short-term correction, and that is to say, and based on our modeling, we're looking at oil prices. Well, in the first half, our modeling had the upper lower quartiles of 125 100, on the high end, 100 on the low end, and that's where we've been. We've now readjusted going into the latter half of this year. So we shifted with the models and what we've seen recently, and we're looking at oil prices potentially as low into the $70 range. That is contingent upon if we continue to see this massive demand destruction that we're seeing. But to your point, as we go into the EU embargo and as we transition, we're in a long-term structural bull market in oil. And while I foresee, yes, oil prices potentially dipping below $80 a barrel in the near future, by the end of the year, I would suspect these prices will be back in that $100 to $125 range, which we've seen through the first half of this year.
All right, Stephen Schork, thanks so much for joining us. Well, coming up, shares of Bed Bath & Beyond soaring today, up just about 24%. It's a retail trader's favorite, but is there more to this rally? We'll discuss next. Just about 30 minutes to go until the closing bell. Three stocks that we are closely watching in the final half-hour trading: Bed Bath & Beyond, Peloton, and Tesla. We have Pras Subramanian joining us here for our triple play. So let's start with mine, and that is Bed Bath & Beyond. Once again, shares are soaring today, up just about 25%. It's one of the most mentioned tickers on StockTwits today. Top mention on Wall Street Bets over the past week. Up for the third day in a row. The momentum from last week carrying over, the company posting a weekly gain of nearly 60% last week. If we hold on to today's gains, it will close higher, which it looks like we're going to. For the 13th time in the last 14 trading days, we are seeing investors buy up this name, despite the fact that the retailer is still struggling to turn things around, reported a net loss of $358 million in its latest quarter. Now, all meme stocks are seeing the buying action today. AMC and GameStop, two stocks that we like to mention, and when we talk about Bed Bath & Beyond, in the red today. Dave, there was a Wall Street Journal article last week talking about some layoffs that Bed Bath & Beyond might be doing to its store employees in order to help it potentially turn around its business. But certainly the retail investor interest in the stock just blows my mind day in and day out.
Yeah, you know, when you look at the whole economy right now, it almost blows your mind.
Yeah,
so this is no exception. I mean, Bitcoin's up and Ether's up and the Nasdaq, the Dow, and the S&P all had a great week last week despite all the bad numbers we're seeing. So I think retail investors are just back off the sidelines because they're seeing the markets, they're seeing Bitcoin, they're seeing Ether. Now, this is just a theory. Highly recommend you check out Brian Sazzi's photo collage on Yahoo Finance about he went to a Bed Bath & Beyond store and all he saw were highly discounted products, which is not typically a great indication for this company, whom Loop Capital recently said will go to a $1 stock at some point. I can't imagine touching that with your money, Praz.
Well, you know, my mom always has the Bed Bath & Beyond coupons whenever I need them to go.
Yes.
Every time. You know, I kind of like Bed Bath & Beyond, but I guess it's a problem of inventory and just excess buildup. Is that basically what's happening? But it doesn't matter for retail investors. Right?
Yeah, and also we've had some executive changes there. We certainly have seen a number of turnaround plans. Nothing really seems to be working, at least as of late. So I don't know. The interest in the stock, when you compare that to the fundamentals of the company, the numbers that we've seen over the last several quarters, things just aren't adding up.
No sense whatsoever. Yeah, searching for a new CEO. My play is Peloton, who has a new CEO, a company on its own streak of days in the headlines consecutive. First came news of nearly 800 layoffs and price increases as well. CEO Barry McCarthy saying it's all part of a plan to become more efficient, cost-effective, and agile. The company will hike prices by $500 for its Bike Plus to $24.95, push the incline button on the treadmill prices by $800 to $34.95. Now news today of a planned redesign to allow customers to assemble their own bike at home after ordering one. Also reporting from Bloomberg that Peloton is exploring letting users stream Peloton content on rival workout machines. The CEO McCarthy also announcing the company hopes to debut its new rowing machine in time for the holidays. That's a lot to take in. If you got all that news, expectations are the machine will cost around $2,000. As for shares, they are down more than 1% today and down 87% in the last 12 months. Their market cap, once more than $45 billion, is now below $4 billion. It's hard to imagine a recovery anywhere near those levels.
You know, the Peloton story is a little confusing for me because they cut prices, they're raising prices. Now they want people to build the bikes in their own homes.
Fire hose of news, isn't it?
Yeah, and it's a combination of, you know, at least for me, the money is expensive, but it's much of a space issue in a city, right? Where do I put this bike? And the ability to actually use that, now the app, or use that technology in, like, let's say your gym at another, like a cyber or whatever type, I can't remember the brand right now, but, you know, other companies make equipment to use that technology or app. I think it's a good idea, but I'm just confused by the whole making the bikes at home and then cutting and then raising prices. It's like, what, $3,000 for the tread? I mean, that's a lot of money. In my opinion.
It certainly is a lot of money. Now, I'm a big Peloton believer. I will throw that out there. I love the bike. I use it all the time. I'm a big fan of the app. I think the classes are great. I think from a corporate standpoint, what we've seen play out over the last several months is also very confusing, going back to what we were just talking about with Bed Bath & Beyond. Now, we do have a new CEO, Dave, like you noted, at the helm, so we need to give him a few more months in order to straighten things out and figure things out. The building the bikes at home was a little bit confusing to me because, I don't know, I mean, I guess it makes sense if you want to cut down on the labor costs there, just in terms of sending out the workers to assemble the bikes, but they're so delicate. I don't know. I guess basically I don't trust myself to assemble the bike. But
well, I put together a grill once, so certainly feel confident in putting together a Peloton. It's actually not that complex when you break it down to its 4 or 5 single elements. But how much cost does that cut for them? I thought that cost would be transferred on to the consumer who pays for that to arrive. But there's a massive uphill plan for Barry McCarthy. But again, I agree with you. I love the bike. I love the app. I think the classes that go well beyond biking are the biggest underplayed asset they have. And they really need to push that forward.
I agree in the classes also. I'd be scared to build those bikes. They're quite heavy. I don't know.
Very heavy.
I mean, I don't know. I don't want to put one together.
The screen alone is so heavy.
Yeah, exactly. Imagine the wheel. So anyway, I'm watching Tesla shares here. Elon Musk in a very joyous tweet saying Giga Shanghai had made over 1 million vehicles there, and now 3 million vehicles to date across all factories. A nice milestone, but one that Tesla has to keep improving on if it wants to hit its goals. You know, the company targeting 1.4 to 1.5 million cars this year alone, and the year after likely targeting 2 million cars. This as competition from GM and Ford is heating up, with those two automakers planning millions of EVs by 2025. So, you know, a lot happening there in that space. Mid-decade and a decade is going to be a huge competition, a battlefield between these brands here.
Yeah, Praj, you mentioned that milestone number, 3 million vehicles that they have produced, paling in comparison, though, to so many of those larger automakers. Toyota, for example, producing over 10 million cars just last year alone. So we know that Tesla has these very lofty goals of increasing production by 50%, but you certainly can see the difference here between Tesla and some of those more traditional automakers.
Indeed, and clearly shaking off the impacts there of the Shanghai shutdowns. Praz, good to have you here, brother. Thank you. All right, coming up, all eyes will be on Walmart and Target as retail takes the stage this earnings season. Find out what investors are expecting after the break. Can you actually save money by eating out more often? For the first time since the 1970s, consumers are seeing the biggest inflationary gap between their groceries and their restaurants. Brooke DePalma here with the details. Brooke, what are we learning?
That's right, Dave. Consumers are seeing the biggest gap in nearly 50 years between food at restaurants and their trip to the local grocery store. The cost of food away from home is up 7.6% according to July's Consumer Price Index, up year over year. But the cost of food at home, that's your local grocery store, up 13.1% year over year. Now, the top items driving that growth of groceries includes eggs, up 38%, flour, and coffee. So, of course, Dave, this leaves consumers questioning, is it cheaper to go to a local grocery store or their local restaurant? Of course, when you're cooking at home, you have to gather multiple ingredients like eggs, flour, and maybe some coffee on the side.
So, Brooke, what's this doing for demand at some of those big name brand restaurants? Chipotle, McDonald's, two of a bit of a different stories when you take McDonald's, more of a fast food chain, Chipotle, a little bit higher end. But are they seeing increased traffic, foot traffic, because of this?
Yeah, well, this is definitely a top conversation that C-suite executives have been having on calls with analysts this past earnings season. I do want to emphasize specifically what McDonald's CEO Chris Kempczinski said on a call with analysts. He acknowledged that food at home is increasing significantly faster than food away from home. And he said, I don't know what the impact of that is, but certainly we expect that there is some benefit that we're seeing as part of that, looking at good value for money. Of course, consumers looking to get those deals. Now, we did see gas peak in early June. Of course, consumers feeling the pinch from that. And according to ad tracking platform iSpot, these fast food restaurants certainly came out with deals in order to get the consumer back in the store. So earlier this year, from January to April, we saw brands offering deals and loyalty rewards, 46% of them. But in May to early August, that number increased to 58% of these names that we know, like McDonald's and Chipotle, offering more deals, more loyalty. Now, iSpot also did tell Yahoo Finance, as an ad tracking platform, once again, that regional brands like Bojangles and Del Taco used value more specifically than these big names in order to lure these customers in.
And Brooke, we could see some apparently higher prices thanks to the water crisis on the West Coast. What might be impacted?
That's right, that drought hitting so many farmers on the West Coast. I did speak to Brad Rubin of Wells Fargo before jumping on today, and he said that water availability is causing producers to move north and plant with higher contract prices. Now, what that means is 3 years ago, it cost tomato producers about $75 per a ton. Now, it costs them $130 for a ton. Now, in 2022, of course, that is the top news. Prices getting higher. But what exactly does that mean for companies like Kraft Heinz, who produces ketchup, as well as those favorite spaghetti sauce brands? Well, tomato producers are looking to produce about 12 million tons of paste. Now, that would require 60 million tons of tomatoes. So in this case, just to see on average, in 2015, California crop reached a peak of 14.4 million tons. Now in 2022, because of those droughts, the U.S. Department of Agriculture is saying that we're only seeing about 11.7 million tons. Now, once again, just to emphasize that number, these tomato producers require 60 million tons of tomatoes. So certainly something to keep a close eye on.
Certainly a heck of a lot of tomatoes. All right, Brooke DePalma, thanks so much. Well, we will get another look at how inflation is impacting consumer spending when we get a number of earnings results from retailers this week, with big names including Walmart, Target, Home Depot, Kohl's, TJX, among some of the big retailers that are set to report. Joining us now for what to expect, we want to bring in Michael Lasser, UBS hardline, broadline, and food retail analyst. Michael, it's great to see you. I guess first, just what's the big thing you are going to be looking for in the reports this week?
The big thing that we're going to be looking for in the reports this week will be how well is A, demand holding up, and B, how fast are these companies working through the excess inventory that they had coming out of the first quarter. This has been putting a lot of pressure on the profitability of the retail sector as these retailers have had to discount that excess inventory. So the faster they can get through that, the better it will be for their profitability.
What do you expect we'll learn from the consumer and how they've been impacted by inflation?
I think there's going to be a couple themes. Number one, continued inflation in the price of consumable items, food and household products, has continued to crowd out spending that's been available for discretionary items like home, apparel, consumer electronics, sporting goods. The second point is that depending on the income segment, spending's probably varying quite a bit. More affluent consumers have been feeling a little bit better about their situation. The lower and middle income consumer has been feeling a lot more pressure, if only because those cohorts of consumers have not had as much support from the government stimulus this year compared to last year.
Michael, we heard about inventory level concerns, promotional environment, namely from Walmart and Target. We're going to be getting those results this week. How do you think the setup looks like for the second half of the year, and should we expect more promotional activity?
So it's best to expect that this is going to be a promotional environment because of all the inventory pressure, as well as the facts that are facing the consumer, like the inflation, like some of the economic uncertainty. So we are anticipating that it's going to be a promotional environment. But once there's a better balance between the demand for inventory and then the availability of supply of inventory, some of that promotional activity is probably going to lessen. And then the big question will be what happens in 2023, and that's largely going to depend on what happens to the labor market. Given how strong the labor market has been, the best way to look at it right now is with some guarded optimism. As long as jobs remain plentiful, wages continue to rise, consumers should be in a relatively good spot.
Gas prices have come down quite a bit, $3.96 today. But how do you expect that high gas prices will really factor in particular with Walmart and Target this week?
Well, I think you made the operative point, which is that there has been almost 5 to 6 weeks in a row of gas prices coming down. The price of the underlying commodity is down 5% today. So that's going to provide some relief to the consumer. With that being said, as you pointed out in your prior segment, the price of a lot of other necessities remains high, like food costs, shelter and lodging costs remain quite high. So the consumer's still facing a lot of pressure, and we're going to see that most likely featured in the results of Walmart and Target, where consumers are having to rely on these discounters as a way to stretch their budgets because they're under so much pressure.
Michael, Walmart and Target's stock prices have really been under pressure. Target off just about 25% year to date. Walmart is also in the red this year. What do you think's already been built into these stocks?
I think what's built in these stocks is that a lot of the margin pressure that these companies have been experiencing this year will persist in the next year. We don't agree with that view. We think once they get through some of the excess inventory, both companies have experienced significant margin expansion over the last couple of years, and that's due in part their store volumes are higher because people have been at home, they've been relying on these retailers. These retailers have been gaining market share as consumers consolidate trips, and they've been able to leverage their fixed expenses with higher sales volumes. Those factors should be more evident next year, assuming that there's just not as much discounting. And so we don't agree with the idea that a lot of the margin pressures that have been present this year will persist in the next year.
Michael, we'll also get earnings from Home Depot and Lowe's, and given builder sentiment fell for an 8th straight month, what are your expectations for those two?
I think there's been a disconnect between the underlying housing market and the way the consumer looks at investing in their home. The instances of working from home are still very high. And that's allowed for more time to do those home improvement projects, to plant a garden, paint a room, fix some items that have been broken because of more wear and tear on the home. In addition, many consumers are struck in a mortgage rate that's well below where the prevailing rates are in the market right now. That creates less of incentive to move and more of an incentive to stay put. And if consumers are staying put, that means they're more inclined to make some home improvements in their house. So we think that what the results of Home Depot and Lowe's are going to show is that the consumer remains very engaged within the home improvement sector.
Yeah, see, Michael, I had to return to the office. That's why I'm not able to improve the home. That's just telling my wife, you know what I mean?
Yeah, right?
That's the only reason.
That's the only thing that's keeping you from doing it?
The only reason for my repairs not happening. Michael Lasser, good to see you. Thank you. All right, now, Shauna, a different story on the retail sector. Nike, giving its employees the entire week off this week without using any vacation days, calling it Well-Being Week. It's actually the second year Nike is doing this. One Nike recruiter said in a LinkedIn post that the move shows employees how the company truly believes in work-life balance. What do you make of this move in global offices? This is no small gesture.
Yeah, I think it's huge. Hopefully we will see other companies follow suit. Like you mentioned, this is the second year in a row that Nike is doing this. I think a couple of things here. One, we know that mental health is so important. We know that there has been more of a spotlight on mental health in the wake of the pandemic, even though obviously it was a huge issue prior to the pandemic. I think this is a great decision by Nike. I also think it will really help them just in terms of company culture and also employee retention. When they're seeing a company, their employer, take an initiative like this, make something happen, allow them to invest 5 full days in their mental health,
I certainly think it's going to pay off in a number of ways.
Retention and recruitment,
Yeah.
if they do have, like so many other sectors, thousands of open jobs. And you're right about the COVID pandemic and the impact, 25% increase in depression and anxiety out of the pandemic. And so many companies talk about mental health and well-being. Not many put their money where their mouth is, like Nike is doing. So we salute that. Kudos. Coming up, Starbucks is now taking aim at the federal government over the union votes at its stores and allegations, what it means for the push to unionize at the coffee chain. Next. More than 200 Starbucks stores have unionized since workers in Buffalo first voted to do so late last year. Now, the coffee chain is petitioning the National Labor Relations Board to suspend all mail-in ballot votes across the country. Yahoo Finance reporter Danny Romero joins us with more on this story. Danny, why?
Yeah, well, this is just the latest battle between Starbucks and labor organizers. Starbucks is allegedly accusing the National Labor Relations Board of unfairly rigging the union elections in favor of the union. In a letter, Starbucks is allegedly accusing labor board officials of acting inappropriately, engaging in highly improper systematic misconduct that included a secret coordination of in-person voting at the NLRB offices when it was intended to be just a mail-in ballot elections. The coffee giant said that this happened during the union election in Kansas City, which resulted in a 6-1 vote. And not only that, but Starbucks challenged 7 of those votes as well, 7 other votes, excuse me. But again, Starbucks is citing that someone from the NLRB office came forward as the whistleblower. So we reached out to the NLRB in response to this, and they sent us this statement that reads in part, the NLRB does not comment on open cases. The agency has well-established processes to raise challenges regarding the handling of both election matters and unfair labor practices. But again, Dave, this hasn't really stopped any of the union elections. There was one today in New York, even though Starbucks is asking that all mail-in ballots elections be suspended nationwide, also any upcoming union hearings as well. But those elections are still moving forward. And like you said, so far, more than 220 stores have voted in favor of unionization, according to the NLRB, and 34 elections are slated to vote in upcoming elections. But labor organizers are really calling the Starbucks move the latest attempt to further distract and undermine the union's success. They sent us this statement from Workers United. Starbucks is simultaneously claiming to stand for voter protections and then asking elections be suspended nationwide. This is hypocrisy at its finest.
Yeah, Danny, what's been the response from Starbucks employees? I would think many of them are extremely upset here with Starbucks' stance.
Yeah, and like I said, I just read that quote in regards to that these Starbucks baristas are really claiming that, like I said, this is the latest attempt to really undermine their success. More than 200 stores have voted in favor to unionize. But I think there's also another question here in regards to, is this, something in regard to, Starbucks is questioning the integrity of the board here. And could this be, the latest move in regards to, the Biden administration's appointed board? And so that's something that, I've been talking with labor experts in regards to this filing. And, what I've heard is that the Starbucks angle here is really to get some of these Republican lawmakers on board to question the integrity of the board here and hopefully make some changes when it comes to mail-in ballots for these union elections.
All right, Danny Romero, thank you. Coming up, we are counting down to the closing bell. Again, gains across the board. All three of the major averages in the green. Dow still up 145. We'll be right back. Just about 90 seconds here from the closing bell. Jared Blickery has a closer look at some of these movers this afternoon. Jared.
Well, let's take a look at some of the action in the majors today. The Nasdaq is a leader. That is up 0.6%. All the majors did start out the day in red territory, however, have climbed back into the green. This would be the fifth straight week for gains in the Nasdaq, as well as the S&P 500, but we got 4 days and change to go into the close. Now, consumer staples, that is a leader today. That's up 1%, followed by utilities. That would normally be a defensive sector setup, but we also have consumer discretionary, tech and healthcare and real estate. All of those are outperforming. And if we take a look inside the Nasdaq, we can see a lot of green here. Tesla is a standout. That is up 3%. Some pharmaceutical names, Gilead, Vertex, up 5%, 3% respectively. And let me just show you, I've been away for a couple of weeks. Let me just show you how much each of these stocks is off their 52-week lows. So Tesla up 50%, Amazon up 41%, Apple up 34%. A lot of these names recently releasing earnings, but I want to check out the retail sector because that is where we are going to go tomorrow. We have Home Depot and Walmart earnings on deck. We can see Costco up 1.5% today, but I'm going to close with the travel sector. We did get some green here. That is on the lowest close in crude oil in some time. And here is your closing bell on Wall Street on this Monday.
Better Business Bureau closing out this Monday. All right, let's check out those markets. You talk about the action on the day. It was another wild ride. We opened with that bad news out of China. Markets fell. We had bad news on the housing data. Markets fell. And here we go. We finished the day up with solid gains across the board as we did all week last week. Dow, S&P, Nasdaq all gained about 3% last week as the S&P 4 straight up weeks. Now, for more on the markets, let's turn to Sound Planning Group CEO David Strzelecki and Upholdings founder and portfolio manager Robert Cantwell. Robert, good to see you. Let's start with you, sir, on what is rallying these markets despite all the bad data that continues to pour in.
Well, we just kind of got to the end of earnings season here, and numbers were not nearly as bad as a lot of investors feared. And so that's why you just had the chart up with a lot of the big names up 30 or 40% in just the past month. A lot of that has been a relief rally over better than expected numbers. And as you get into the rest of this year, it's very likely that those numbers are going to keep looking better. Because if you go back to the first half of 2021, we had a really strong period of growth, and companies struggled to show growth rates in 2022 over that period. However, the second half of 2021 slowed big time. And so you're already seeing Adobe put out their e-commerce report in July. E-commerce revenue was up 20% over July of last year. So we're seeing some really positive signals that at least within internet and e-commerce, there's quite a bit of recovery underway.
David, what do you think? Because there is debate out there about this rally. Morgan Stanley saying that this bear market rally is about to run out. JP Morgan on the flip side saying that it actually has some legs. What do you think?
Great question. I'm probably just going to take a slightly different answer to that and noting that, I'm looking at the consumer right now, and I think the Walmart story tells it right. Between gas and groceries, there's a lot of discretionary spending going out the door, and we're just not buying a lot of the same things as we were previously. And so we're certainly seeing a softening in our market while we're seeing a bull rally in what I believe is a bear cycle. And we're in the beginning innings of what's probably going to be a longer ball game as we continue to go forward in it. But I'm just concerned about new regulation, new taxes. Those have historically not been great long-term effects. So I love the bull market. I'm riding it. We're doing wonderful. A lot of these names are names that we hold, but we just need to be cautiously optimistic as we're going forward here.
Robert, David talks about the Walmart story, which we'll really get a read on tomorrow with their earnings. And without asking you to dive inside those, we'll hear from Target. We'll hear from Walmart, Home Depot, Lowe's. Broadly speaking, what do you think the takeaway from the health of the consumer will be later this week?
I think David made a great point there, where there can be quite a lot of economic shift that happens underneath the surface. And so the goal as investors is you want to be positioned in the categories and products and businesses that are net beneficiaries going forward. And even within Walmart's, even in their last report, they talked about big shifts in consumer spend across various product categories that they have. But what does it mean for consumers to spend less on Walmart than they are in other areas? So just a little bit earlier on the show, you had real estate and how real estate looks like it's softening a little bit. But the reality is that real estate has had an incredible 12-month run. And for a little wind to come out of the sales of real estate is not really a huge problem for a lot of real estate investors because where a lot of the opportunities have shown up in the market lately, digital advertising, cloud computing, these enormous growth industries that maybe got a little bit overpriced last year, we're starting to see those prices look really, really good again. And the fundamentals are continuing to hold up. And that to us is spend shifting beneath the surface as opposed to having to worry too much about how much is the economy growing, month in, month out.
David, we have seen inflation come back a bit, now at 8.5%. Lots of questions about what this means for Fed policy going forward. If the Fed is actually going to get too aggressive, then what that could mean here for the markets. How do you see it, and what are your expectations for the Fed here over the next couple of months?
Well, the Fed certainly needs to be raising rates a little bit more. So we're about at 2.5%. Everyone's talking about it. I think that because we've seen such strong jobs reports, we've seen CPI kind of flatten out here at the 8.5%. I think the Fed knows that there's some work that needs to be done, and they've ultimately signaled to us that they're going to be more gearing towards fighting inflation as opposed to trying to keep jobs. So instead of that dual mandate that they started out with, I think that they're really looking to capitalize on this inflation story because they know that they're behind on it. First quarter here, we were not raising until March. And so, we're late to the party on some of this. We've got more to go between now and July next year as they're projecting. So how do we finish the year out ultimately depends, but I do not see the Fed really getting dovish quite yet. Not until we see a contraction, until we see things really pull back. And then there's the turnaround. So I'm looking for another bottom here in the market as a result of just the time that it takes for the Fed's responses to get priced into the market, specifically with real estate and how businesses metabolize their debt.
Robert, let's go there on the Fed. I mentioned this earlier in the program that former New York Fed President Bill Dudley said that markets are misunderstanding how the Fed is fighting inflation, pricing in cuts at the end of next year. Do you agree with that premise?
I can't predict the future, but what I can tell you is that
we're talking about the present. We're talking about the present, not the future. We're talking about, are the markets misunderstanding the Fed's mission?
Are the market? I am not going to be smarter than the trillions of dollars that are traded, within the bond markets. But what I will say is that as interest rates go up and down, there are businesses that flourish, and there are those that get wiped out, and then there are those that just kind of keep quietly growing. So to give you a nice tangible example of that, mortgage origination companies famously go in and out of business with interest rate cycles. By comparison, FICO, a consumer credit reporting agency, has been in business for 40 years, has never been wiped out, during an interest rate cycle. And so to us, when we're looking across the market and we're looking at where there are opportunities, what's telling us about the health of consumers and things like that, we look more to the businesses like FICO that survive market cycles, because we think that's where you can learn a lot more about the durability of what's happening. And so this is why I shared with you a little bit earlier where some of the recent softening in real estate has been relatively mild in the history of real estate softenings in this country. And if rates do go up another 2 or 3%, and if folks are wrong that the softening is not going to happen in the second half of 2023, there's still so much buffer in the equity value of real estate prices right now that we think that the economy is perfectly well suited to handle it.
All right, Robert, David, thanks so much for joining us this afternoon. Coming up next, we're taking a close look at streaming. There are so many streaming services to choose from that there are signs that we may be seeing streaming fatigue. We'll explain after the break.
Cool, thanks.
Streamers are having a hard time holding on to subscribers as more consumers cancel their subscriptions to save a few extra bucks. Yahoo Finance's Ali Canal has the latest on this for us. And Ali, there certainly are so many to choose from these days. People find themselves paying just too much for some of their streaming services.
Yeah, you know what, Shauna? I don't really think we should be surprised by this. This was a trend that we were seeing even prior to all of the increased competition, but we have some new data now to actually back all of this up. According to subscriber measurement firm Antenna, about 19% of subscribers to premium services canceled 3 or more subscriptions in the 2 years leading up to June. Now, that's compared to just 6% in the 2-year period leading up to June 2020. We're talking about the big platforms here, Netflix, Hulu, Apple TV+, HBO Max. Despite all of that content, consumers are getting a little bit more choosy. As you were mentioning, it's becoming a lot more expensive to subscribe to all these different platforms, and they want to be a little bit more frugal with their money. In fact, if you combine all the top platforms and select the ad-free version, you're spending around $90. So streaming is not the cheapest game in town anymore, and that's why it's so important to have that high-quality content. And it's also why we're seeing a lot of these platforms look for other ways to expand their customer base. Walmart, for example, is reportedly partnering with Paramount Global to bundle that service into their Walmart Plus membership program. We've seen other platforms like Netflix and Disney partner with wireless providers like Verizon for that same exact reason. So it's all about making your platform as sticky as possible, especially since in today's world, it's so easy to just jump from platform to platform.
Yeah, Ali, what are the other strategies? I mean, we've seen Ted Lasso, for example, spread out episodes over the course of several weeks instead of dumping them at once. Are we going to see more do that? And the other thing I've always wondered about, do any of these streamers incentivize customers staying and retaining their membership over the course of a year?
Yeah, and I think that's a really great point, Dave. I think we've seen some experimentation with just not binging TV all at once. That was a Netflix model that worked really well, but now we've seen HBO, Apple, some other platforms experiment with just releasing maybe 3 episodes at once, waiting a week, and then doing it week by week. Others are still dumping them all out. So I think there's still a lot of experimentation going on in the landscape right now. I also think it's interesting to see how some of these big tech giants are trying to be a Roku in a sense. You know, we've heard from YouTube, they're reportedly planning to launch an online store for streaming services. So you can subscribe to YouTube TV and then select your platforms a la carte and add that onto the subscription. So to me, that's just a way to threaten the status quo right now. I know a few people that subscribe to YouTube TV and love it. So with this online store, potentially that could be a threat. And again, it's all about creating that stickiness. I think that's the key word in the streaming wars right now.
I just want to follow up on that YouTube plan. So how does that work? If I'm a consumer and I can go to YouTube and that is my gateway, if you will, to all the other streamers, how does that work?
So they're going to have to partner with individual platforms and then they'll share some of that revenue, right? So it's sort of this win-win scenario where these platforms are on that YouTube TV marketplace. So they're able to access consumers in an additional way. And then YouTube gets a cut of that revenue. So apparently this has been in the works for about 18 months. YouTube taking it pretty seriously. We could see this be an offer by this fall. And I just think it's interesting to see how the streaming wars have evolved, because it sort of feels like we're going back to a bundled cable package in some ways. But then again, with so many services out there, maybe that's what consumers need right now, just a centralized, streamlined platform. I don't know what you guys think about it, but there's certainly a lot to chew on right now with the landscape.
Yeah, YouTube also gets a boatload of consumer data with that. A lot of more people pouring into their platforms and then going elsewhere, whereas that is probably an interesting side angle to that. But yeah, your point is a good one, that it does feel like everything we tried and wanted to get away from in cable TV, we are sort of now getting right back into with the streaming marketplace, aren't we? In terms of cost, in terms of options, in terms of bundles?
Yeah, I certainly think so. And I think that's why we're going to see a lot more consolidation in the streaming wars. Already, we're starting to see that with Warner Bros. Discovery. They're combining Discovery Plus with HBO Max to be one service. And perhaps later on, we'll see the bigger guys gobble up the smaller guys, because I do think you're going to reach a certain point where there's just too many platforms, too much content, and too much money. And we're already seeing consumers kind of jump around to the different platforms. So I think it's going to be interesting to see who really survives at the end of the day, and what sort of partnerships that we'll see moving forward, because I think that's a big question mark right now.
Yeah, these stories all go hand in hand, don't they? Because really, the more they drive up the prices and bundle things together, it forces people to be nimble and to move around, because we don't want these massive bills every month like we had with cable TV. Good stuff. Allie Canal, thanks for coming on. All right, coming up, Florida, like several other states, is facing a teacher shortage. Coming up, we'll tell you who they're turning to cover the shortfall.
The UK is now the first country to approve a dual COVID vaccine targeting both the original virus and the Omicron variant. Anjali Kamlani is here with that story. And Anjali, certainly huge news for the UK. What does that mean for the timing here in the US? Because there certainly has been talk of an updated vaccine that's targeting Omicron.
That's right. So our timeline is a little bit different because the FDA asked these companies to do a separate vaccine for us, for the U.S. population, and that is the BA.5 and original strain of bivalent vaccine. So Moderna and Pfizer are both trying to target basically next month for rolling these out when the Biden administration asked them to. They originally did say that they would only be able to get to it by October. We do know also that this Omicron bivalent was what they had hoped the U.S. would be asking for because they were already in the works for that. So right now, the UK is the first to green light that Omicron bivalent. We know that the EU as well as Australia and Canada are also looking at this same one, and we're going a separate route. So these companies have to then make those vaccines for us separately.
Needless to say, we spend most of our time talking about the U.S. and, of course, the U.K. in terms of vaccines. What about lower and middle-income countries around the world?
I'm so glad you asked. So what we're seeing now is really a shift in policy and a shift in what these companies are looking at. If you look at Moderna alone, its ex-US COVID sales are greater than the US. And so we're looking at countries, at companies that are targeting low and middle income countries like Novavax, like Vaccinity, who are working on either the original strain or second generation to really ramp up the global vaccination scene. Right now, a quote from the Vaccinity CEO in a recent interview with me talking about the market there and how largely, these LMICs or low and middle income countries have been largely ignored. And she said, quote, they've never been on top of mind for most U.S. drug companies, but there's a lot of market there. And it's true. If you think about the total population of the world by comparison to the U.S., right, it's obviously a lot more. So that's what a lot of companies seem to be looking at for right now.
Yeah, we often forget. We're actually
right.
a small slice.
Small part.
Even though we dominate most of the news. Anjali Kemlani, good stuff. Appreciate that. All right, students across the country heading back to school, but many without adequate teachers. According to the National Education Association, there are more than 280,000 fewer public school teachers nationally than prior to the pandemic. And the shortage is perhaps most acute in the state of Florida, where there are an estimated 8,000 teachers short. Andrew Spar is the president of the Florida Education Association. He joins us now. Good to see you, sir. Really appreciate you coming on, talking about the situation. What are the implications for the system in Florida and most importantly, for the students?
Well, first, thanks for having me here. And there's lots of implications. For example, in Orlando, Florida right now, they don't have enough bus drivers, so they're doubling routes, meaning kids are having to be picked up early in the morning, brought to school, having to wait before the school day so that another route can be run to bring more kids to that school. Or another school district today actually had 20 and 30-minute delays for their middle school, the last runs they did, because they just don't have enough bus drivers. In the classroom, my own daughter last year in 7th grade, her science teacher quit in the middle of the year, saying that she wasn't willing to sacrifice her small family anymore for when she can't even teach the kids the way they're supposed to be taught. And so she walked away from the profession after 12 years. They couldn't find another science teacher, which means my daughter and 99 other students this teacher taught didn't get the education they deserve and need in science last year. So these are real ramifications by not having fully staffed schools to support every child who comes into our classrooms.
And Andrew, one thing that Governor DeSantis has announced that he is doing is recruiting veterans to teach in classrooms in an effort to address this teacher shortage. Let's play a quick clip of what he had to say about this.
Our veterans have a wealth of knowledge and experience they can bring to bear in the classroom. And with this innovative approach, they will be able to do so for 5 years with a temporary certification as they work towards their degree.
So, Andrew, they have a temporary certification, not a full certification. First, just your reaction to what we just heard from the governor.
So first of all, I appreciate our veterans. I think we all do, and honor them for the work and service that they have done to our country, keeping us safe and protecting our freedoms. But let's be honest here. This doesn't really get at the root of the problem. As a parent, as other parents as well, we want to make sure that we have fully trained, fully credentialed teachers in our classroom with the experience and support they need to teach every child. This idea of shortcutting that process doesn't work. It never has. And let's face it, right now, there are veterans who do come into our schools through the traditional process and become teachers. But you can't just say because someone has been in the military or someone has been in a classroom even, that makes them a highly qualified teacher. It takes skill, it takes training, and it takes a desire to be there. And if you're constantly maligning teachers and staff who work in our schools, if you're underpaying them, under-resourcing them, then they're not going to stay. And that's what we're seeing here in the state of Florida.
And we'll circle back to the root of the problem. But Andrew, if I could just follow up on the veterans, are there an abundance of veterans in this situation in Florida that are willing to teach? And have you heard any reaction from veterans groups?
So I have not heard of veterans being lined up wanting to come into the teaching profession. I have not heard of anyone right now lining up to come into the teaching profession right now. I mean, in fact, since 2010, we went from 8,000 graduates in Florida's colleges and universities who wanted to be teachers down to about 2,000 or 3,000 this year. That's a major issue. We don't have people coming into the profession, and that's what we need to do. We need to encourage more people to come into teaching. We need to encourage those who have left. There are lots of certified teachers in the state of Florida who have walked away. We've got to get them to come back to the profession and come back into our classrooms. That's the best way to solve the challenge we have right now.
Well, Andrew, how do we get them to come back? What's the answer there?
Well, I think it's twofold, right? One, we have to pay teachers more. In Florida, we have what is known as the experience tax. There are actually 20 different laws and rules that govern teacher pay that are chasing people out of the profession, that are working against teachers who have experience. We call it the experience penalty. Two, we have to show respect. When the governor goes around the state maligning and vilifying teachers on a daily basis, it hurts the profession. It chases people out. We've got to get those great teachers to come back, and we can't do it unless we all work together, lift up the teachers and the staff who work in our schools, and pay them a respectable wage.
There, of course, is a national teacher shortage. I mentioned the 280,000 fewer than we started with prior to the pandemic. You're suggesting that your governor is doing things that is chasing away teachers. We are seeing this problem in all 50 states. It may be most acute in Florida, but clearly it's not solely a political issue.
No, look, it is a political issue in the sense that politicians make the policy, and the policy in a lot of our states lately has been a policy that has maligned teachers and people who work in our schools. It has been underfunding and under-resourcing our schools, and these are the consequences of those decisions that have been made really for the past 10 or 20 years. We've got to get out of that realm of thinking and get into the possibility of actually empowering educators, trusting educators. You know, we look at other countries around the world. We're often compared to other countries around the world, Finland, for example, where they actually value and respect teachers. They pay them a decent wage. They give them control over the classroom, and they trust them as professionals. That's a concept that really came from the United States, but we haven't implemented it here. Let's do that. Together, we can do so much more to support our teachers and staff in our schools, to ensure that sacred bond between teachers and parents, to make sure that every child is getting the education they deserve and need.
Andrew, if these changes aren't made, how much worse do you think this situation could potentially get? And the current situation that we're in now, how long do you think it's going to take to hopefully correct it?
Look, a few things, right? Last year, there were approximately 4,000 teacher or 5,000 teacher vacancies at the beginning of the school year. This year, 8,000. So there's a big jump. We've been seeing this steady increase, but a jump like what we're seeing this year is unheard of. So we've got to act and act quickly. So first of all, I encourage everyone, there's a primary election happening in Florida in a little over a week. I encourage everyone to ask anyone running for office, whether it's school board, state house, state senate, or the governor's race, I ask them, what are they doing to address the massive teacher and staff shortage? If they don't talk about increasing funding, if they don't talk about increasing resources and support for our teachers and staff, and if they don't talk about encouraging young people to go into the profession and really changing how we do business in public education in the state of Florida, then don't vote for them.
Andrew Spar, we really appreciate you taking the time. Florida Education Association president. We hope to have you back here in the future. Certainly an important story that we will keep monitoring here at Yahoo Finance. All right, well, coming up, milk, eggs, bread, and a bet on the Browns-Steelers game. Well, it could actually be in the cards for Ohio residents. We've got the details when we come back.
When you go to the grocery store, your usual list contains things like produce, eggs, meat, and well, if you live in Ohio, you could soon be adding another item to that list, a sports bet. Supermarket chains Kroger and Acme Fresh Market are reportedly applying for licenses that would allow them to add sports gambling kiosks at select locations throughout the state. Over 1,000 bars, restaurants, and bowling alleys throughout Ohio are also making the same play. And we asked you on Yahoo Finance, where would you make a sports bet? Would you make it in a bar, restaurant, in a grocery store, in a bowling alley, or are you solely going to make that bet online? And the results are overwhelming. 75% take a hard pass on all that. 20% say they would do in a bar or restaurant, and I would have figured it was about 80-20. That was my guess.
Yeah, exactly. I think it lined up with what we were talking about earlier on in the day. I do think, though, it makes sense for Kroger. I don't think it hurts to put these types of kiosks inside their store. If you do get a couple more people inside their store, maybe they'll go buy a few more items. So it could make sense just in terms of revenue. You look very, very skeptical.
I do.
I
am very
I think
skeptical.
you obviously will see a lot more interaction, a lot more use from these kiosks in bars and restaurants. One, a lot of people go to those types of establishments to watch football games, to watch sporting events. And they're more likely the people, obviously, that are going to bet on these big games. It'll be interesting to see how this plays out across the country if more states follow Ohio's lead on this. But
yeah, look, I agree with you. It probably can't hurt unless it attracts a crowd that you really don't want hanging around the grocery store, which could be the case if you're Kroger. But to me, the bottom line is, I don't know about you. You go into a grocery store, at least I do. I want in, I want out.
Oh, yeah.
The last thing I want to do is linger 5 more minutes. Now, a bar or a restaurant, I actually expected a little bit higher number there because you're sitting, you're hanging out. In particular, if you're at a sports bar, that seems like the ideal location other than an app.
You just can't compete with the phone because it's so easy. If you could place the bets online, why would you actually be, even just getting up from your seat? I'm a little lazy. I think I would just do the mobile phone.
Yeah, I'd also be curious, would you turn some of your customer base off if you are Kroger? We're hopefully reaching out to their CEO, see if we'll come on to talk about that. I don't know if all the moms want a mix of the sports gambling audience at the grocery store, but maybe it's totally an aside, separate area. They have not been approved yet.
Right.
So we'll see. All right, inflation hovering near a 40-year high, and many people rely more and more and more on their credit cards. Recent data shows credit balances jumping by 13% in the second quarter from a year ago, the biggest gain in more than 20 years. It's not all bad news, according to our next guest. Joining us now, Yahoo Finance contributor Vera Gibbons. Vera, nice to see you. So it's not all bad news? Tell me more.
It shows that consumers are confident, so we're feeling pretty good about things. We're spending, but in large part, we are spending more and putting more on our credit cards just because, as you point out, everything is costing more. The latest inflation data does show that things are "quote unquote" cooling off a bit, but things are still historically high on everything from gas to groceries to rent. So we are putting more on our credit cards in large part because we are forced to, but we're also spending more on experiences and travel. There is that big pent-up demand. And also, we're putting more on our credit cards against a backdrop of a decline in cash usage. So there's a number of reasons why we're putting more on the credit cards, but in large part it is because everyday expenses are costing more. And what are we supposed to do? So,
very true. Are we seeing delinquency rates on the rise?
You would think that delinquency rates would be on the rise given the fact that we are spending more on our credit cards, but they're still at pre-pandemic levels. I mean, there is one slight worrisome group, and that's the subprime borrowers, because we are seeing delinquency rates rise a little bit amongst that group. But I think overall, lenders are feeling pretty confident because they look at the job market, the job situation. And if you look at that, it's one of the strongest job markets we've seen in decades. Unemployment's at a nice low. That's really the biggest indicator as to whether or not someone's actually going to pay their bills and pay their bills on time. And interestingly enough, a lot of us are paying our bills on time, and more Americans, a near record number of Americans, are actually paying their debts in full. Part of it has to do with the fact that over the past couple of years, we've had some cash in our pockets, prompted by government stimulus. So there's been some liquidity, and we've used some of that cash to actually pay down our credit card debt. I think consumers have actually learned that this is expensive debt, and given the fact that the Fed is on this interest rate hiking campaign. We've already had several interest rate hikes. They're expecting more. People are paying more attention to what's actually going on in the economy, and they want to actually pay this down. I mean, if you consider that before the Fed started raising rates, the rate was about 16%. Now it's hovering around 18% on the national average. I think more people are going to be paying more attention to paying down their debts.
I know I am, as the Fed continues to raise rates. No doubt a huge impact here. How about some tips, best ways to pay down your debt?
You know, it's interesting because I talked to a couple of people. They said they just sold a bunch of stuff on Facebook Marketplace to pay down their debts. Other people have had that cash, as I mentioned. They've had the liquidity. They've used that to pay down their debts. Some people have taken on part-time jobs to pay down their debts. But I think the two more common ways are, the snowball method or the avalanche method. The snowball is when you just chip away at the smallest balances first. You feel a sense of victory, so you move on to the next credit card. Avalanche is when you attack the card with the highest interest rate first and then work your way that way. But there's really no one-size-fits-all strategy. But the main thing to know is that this is, in fact, bad debt, and this bad debt is getting more expensive. The average household has maybe $5,000 in credit card debt, but people I know, and you may know as well, sometimes carry much higher balances. And if you run the numbers using an online calculator on bankrate.com, for example, you'll see that carrying this debt becomes really, really expensive. And the amount of interest you're going to be paying over a certain time period doesn't look, that shouldn't actually entice you to pay more attention, probably.
All right, great stuff there. Vera Gibbons, appreciate you coming on with those tips. Good stuff. Up next, she read the fine print so you didn't have to. TikTok's money lawyer, Erica Kohlberg, shares some of her most viral hacks. Coming up.
Hi, I'm here to get new AirPods Pro for free. We can't just give you new ones for free, but mine are making these static sounds and noise cancellation isn't working as expected. Did you buy some kind of Apple Care plan? No. Then nothing we can do, sorry. Next. She has no idea I follow Erica. Watch this. Actually, I read your terms and I know that you'll replace AirPods Pros with these issues as long as it's within 3 years after the first retail sale. Let me check yours. Oh, fine. We'll replace yours for free. Who taught you this? Erica taught me. She's a lawyer and reads the fine print, so I don't have to. That's why I follow her.
All right, that is Erica Kohlberg, aka TikTok's money lawyer. Erica, she has nearly 9 million followers on TikTok, 15 million across all social media, and is known for reading the fine print so we don't have to because we're lazy and we don't read the fine print. Erica joins us now in studio, and with that reference with the AirPods, you have my attention. But first, before we get into your hacks, I want to ask you, as a lawyer, as an entrepreneur, there's so many people sitting on the sidelines that think, I might have a skill or an interest, but I don't know if I'll resonate in social media. What do you tell those people?
You just try. Social media is so accessible. All you need is a camera and record and then post it. That's it. It's very simple. Just try.
Erica, how did you come up with it? Because it's so smart. It pertains to nearly every single person's life because you talk about a range of topics. So how did you get started with this?
I like talking about things that empower people with their money. And I thought, okay, I have 30 seconds on a TikTok to give someone an actionable tip that they can walk away with. And it was very easy to get into this fine print. There are so many topics I can go on and discuss around fine print hacks and how to save money.
So do you suggest that people just start, you said just start doing it, but a lot of people have that fear of, I might put out a video and I might get 2 or 3 likes. So how do you overcome that fear and stay with it?
For me, I was so terrified up until the point, but once you hit publish, it's irreversible. So it's just out there, and I think the fear subsides after that.
Erica, what about your background as a lawyer? You were an attorney, now you're doing this full time. Do you think that helped you get started or helped you kind of gain the followers that you have today?
It made me more appreciative of what I'm doing now. So I still practice law, but it's a very small portion. But it's so great to be able to wake up and do things that I enjoy instead of just being tied to a desk.
All right, I keep talking about all the boundaries that keep people from jumping in. How much time does it take? How much of a commitment does it take to succeed on social media? And I always hear talk with Logan Paul about this. Consistency is the key. How much do you have to put out there?
For me, when I first started on TikTok, I committed to posting a video a day. So for the first 30 days, I posted 1 video per day. And I agree that it is a lot about consistency and also giving value to people. So whether it's entertainment or education, you need to go on social media with an idea that you want to provide value to people. And if you do, people will follow.
And what about the pay? Because big names like you have a massive following. Obviously, brands want to partner with you. And some of the criticism from some of the creators in the creator economy have said that there needs to be more pay transparency just in terms of making sure that they are paid enough. What do you make about that and the challenge that this presents to people like you?
It's so true. I've actually seen brands underpay many people. I myself started an agency to represent creators because I saw how many people were getting underpaid. And I think the best thing you can do is within your niche, talk to other people. Go to the other finance TikTokers and say, hey, how much is this brand paying you? And that's how we can get a little closer to that pay transparency.
Very interesting tips. All right, we want to talk through some of your actual viral hacks. Again, you read the fine print so we don't have to. Travelers, everyone is frustrated, out of their minds from delays and being booted off of flights because it got oversold. Tell us how we go through this if you are involuntarily denied boarding.
So if you are involuntarily denied boarding, meaning bumped from a flight, so the airlines will oversell tickets. They'll sell more tickets than seats on the plane. And if they say, hey, we're going to bump you from this flight, you're in most cases entitled to compensation based on how long of a delay it causes to your arrival. So if it's over 2 hours, you're entitled to 400% of that one-way fare.
Wow. I feel like that's something that nobody knows.
400% of the one way, but if you have a round trip, so you're literally just breaking that in half?
It depends on how the airline is going to calculate it, but the DOT rule is 400% of the one-way fare.
And Erica, you have a lot to do with travel, because also not only if you get bummed from a flight, but the baggage fees, and goes on and on and on, but also in the retail space. Nike, you did a video about this. It got millions of views. If your Nikes are damaged, they fall apart, you actually have a hack on how to get a free pair. What is that?
Yes. So a lot of people know about the 60-day return policy, but not a lot of people know about the 2-year warranty. So if there's a manufacturing defect, let's say almost 2 years after you purchase, there's a tear in your shoe, you can go return it for a gift card or a refund.
No matter how it happened?
It depends, because wear and tear isn't a manufacturing defect, but something like, it really depends on how they judge it.
Okay, that is one.
But I've had hundreds of followers say that it worked for them.
And you take it back to the retail store where you bought it, even though it's technically a manufacturing refund, right?
The best thing I always recommend doing is go online first, because it'll save you the embarrassment of having to go in store. I know a lot of people are shy and don't want to be like me and be like,
I'm one of
"Here's my
those people.
shoe."
I get so awkward. Yeah.
So go online first. With any of my hacks, the best process is always to initiate it online.
Okay, so inflation, as all we talk about these days, remains high. Many Americans are certainly relying on their credit cards more and more for extra help. What can you do if you have something stolen on your card? What do you do then?
A lot of credit cards come with purchase protection. So if your AirPods are purchased on your credit card and they're stolen or lost, that credit card may have purchase protection where it'll actually give you the money back to go purchase a new pair.
How do you figure out which credit cards this pertains to? Because I don't know, I have Chase, for example. Is Chase
so you can look up your credit card and then add purchase protection and just Google that and see if it covers.
I want to circle back to where we started with the airlines, because again, thousands of people out there are just pulling their hair out because they're spending 8 hours on the phone. They're not getting refunds. They are moved 4, 5, 6 hours. They're having to buy hotels because their flights are canceled. Where do we find these tidbits that they do have to do for you? Where do we find that fine print?
So the first place I always go is the Department of Transportation. So search the Department of
Transportation. Not on the
airlines.
Website. Okay.
And then the second step would go to the airline's contract of carriage to see what they have in there.
And Erica, I mentioned it quickly before, but you also have a hack when it comes to bags, right?
Yes.
If the airline loses your bag, that's right?
Yeah, if the airline loses or delays or damages your bag, they're liable for up to $3,800. So for example, if your bag is delayed and you're on a business trip and you need to go buy a suit before your bag arrives, you can expense that and get it reimbursed by the airline.
Okay, lastly, I think this is all coming to a podcast. Tell us about that.
So I have a podcast launching called Erica Taught Me. It's going to launch next month.
Wow.
And where can we find that on iTunes? Or
on YouTube, everywhere where podcasts are streamed.
Well, we can't wait for that because we don't read the fine print.
We certainly don't. We rely on you.
Erica Kohlberg, great to see you.
Good to see you. Thank you.
All right, Snapchat shares closing, up quite a bit, 5.5% on the day, announcing some new features for its Snapchat Plus service, which they say now has 1 million paying subscribers. New features to the $3.99 a month service include post-view emojis, which allow you to select an emoji your friends will see after they view your snaps. There is also a feature called priority story replies, which will make your replies more visible to celebrities and influencers, which I know matters an awful lot to Shauna.
It certainly does. All right, Dave, let's take a look at some of our after-hours movers here. A couple of names to keep in mind as we transition our focus to tomorrow's opening bell. So we have Apple here off just a fraction, Amazon just about flat here after hours. The reason why we're bringing up these two names, even though we're not seeing a huge movement in the stock, is that Berkshire Hathaway actually boosting its stake in both of these companies. This coming from the 13F filings that were just released after the bell. Now, previously, Berkshire did disclose in its 10Q filing that Apple was its largest holding as of June 30th. So Apple and Amazon, two names to keep in mind as we look forward to tomorrow's opening bell. Tencent, another mover here after hours, up just about 3%. Tencent out with earnings after the bell. A couple of numbers here. 9 cents on EPS, beating the street's expectations. Sales, though, coming in a bit short, just over $1 billion. Their paying users, though, did rise during the quarter, up to 82.7 million. Mobile monthly active users of online music, 539 million. That slightly missed the expectations, but the paying users seems like what the street is paying close attention to. That up just about 3%. Let's take a look at ZipRecruiter. ZipRecruiter falling off just about 5% here after our third quarter revenue guidance coming up short, cutting their full year revenue view. A big part of this is because of what they've seen in the labor market over the last couple of months. Now, CEO Ian Siegel saying in the earnings release that while the quarter was strong in June, we did begin to see some signs of a cooling hiring environment. That's why they lowered their forecast for the year and for the third quarter. For the second quarter, EPS topping the street's estimates at 11 cents, sales of $239.9 million. That's a jump of 31% from just a year ago. Let's take a look at Compass. Now you can see Compass off just about 12% here after hours. The street not too excited about the numbers that we're getting there. A wider loss than what we were initially looking for, a loss of 24 cents. Revenue of $2.02 million. That's up about 4% from what we were seeing a year ago. The company also announcing new cost reduction program with approximately $320 million in savings. We're seeing the action after hours with shares off just about 12%. Dave?
Thank you, Shauna. My stock to watch for Tuesday is Walmart, America's top retailer, reporting second quarter earnings tomorrow after cutting its full year outlook in late July, saying inflation was, quote, requiring more markdowns to move through the inventory, particularly apparel. Walmart missed first quarter earnings per share expectations for the first time in 5 quarters, and expectations are for Q2 EPS to come in at $1.62. Of particular interest on Tuesday is how the company's grocery business was impacted by inflation. Shares of WMT largely flat today, as you can see, up about 0.3%. Coming up, bringing the Barbie world into the real world. We're looking at the new trend in interior design that has many homeowners seeing a lot of pink.
As fans get ready to watch Margot Robbie take on the classic role of Barbie in a new movie, the pink girly girl vibe has taken on a life of its own. Celebrities are dressing in pink. People are decorating their homes in hot pink decor. TikTok has registered 9 million views for the hashtag Barbiecore. This is according to the Washington Post. Dave, this is amazing. I mean, we know it's a bright color. It obviously will boost people's mood if you walk into a bright space. But get this, Etsy, the searches for hot pink home decor items has been up 21% in just the past 3 months. And we have about a year to go until this new movie comes out. So maybe you should get ready to see some hot pink in your own living room. You never know.
Oh, dear. July 21st next year. Listen, this is a shocking trend, if you ask me. Barbiecore. Decorating your home like a Barbie dream house sounds like my form of hell. It sounds like utter torture. And what was really surprising beyond the Google searches and TikTok trends is that there are married couples that have this. I just figured it was single women that, wanted to celebrate
Everyone wants to get in on it.
But walking into a pink room, sure, it can make you happy and make you lift your mood. But every day, when you're walking into that room every day, I think it's just going to decrease that mood.
Yeah, maybe if you want to incorporate it into your home decor, it would make sense if you just decorated it with a corner of a corner space in just one room, or maybe one room that's off to the side that you don't go into every day. Maybe it's a bathroom that you don't use on a daily basis. If you have one, it could make sense, but I don't know. I'm with you. I think I would get very, very sick of hot pink pretty quickly.
I can tell you retailers are hopping on because Benjamin Moore even has a color that they are recommending to those Barbiecore fans. It's called Peony, if you were looking to do a Barbie house. And the other thing I found interesting about Barbie, she's been around since 1959, and to take it back to us being a finance network, you might be wondering how to do the story. Look, who has more professional experience than Barbie? Do you know how many careers she's had over the years since 1959?
No idea.
200 careers. So what a versatile worker Barbie has been over these many decades. I think we're both going to hard pass.
We're going to hard pass for now.
Core.
But we have a year maybe until maybe some of the excitement's building around this movie, but I think it's safe to say.
She's having a moment.
She is having a moment. We can't take it away from her.
Having a moment. That will do it for us today. No pink in our living rooms. For Shauna Smith, I'm Dave Briggs. We'll see you tomorrow, 3 o'clock Eastern Time.